and we are getting into Unit 12. So when we left each other last week, we just finished Unit 11, and Unit 11 was the relationship between the landlord and the tenant. So in Unit 12, we're going to bring the real estate agent into it. So if you're a licensed agent, and you're being asked to manage property for somebody, you're coming in as the property manager. And that's what we're going to talk about this morning. Good morning. So Unit 12 starts on page 331. Do I have anybody going into property management? Anybody going into that? Some of you were like, no, You just look terrified. You don't have to, it's okay. But a couple of you might go into it. So, you know, some people will tell you it's a dying field. So it might be a niche for you at some point. But of course, once you guys get licensed, you're free to do whatever you want to, as long as the property is located in the state of North Carolina. So do you want to do residential sales? Do you want to do commercial? Do you want to do property management? The possibilities for you are endless. So just, a few things to keep in mind as we go through this unit. I will say this. I think of all the units, this is the one that gets studied the least, because the majority of you aren't going into property management. And for example, if you're going to go into residential sales, you may be thinking this doesn't apply to me. But remember, we got to get you through the tests. So you will have a few test questions from property management, regardless if this is going to be your field or not. Once we get through the test, if this isn't what you want to do, then you don't have to worry about property management again. So in Unit 12, we're going to explain what the property management role is, what the property manager does. We're going to talk about some basic elements of a property management agreement. The property management agreement we will learn is our agency agreement. It's our contract between the licensee and the client. And then there's some math, and the math in Unit 12 is more investor math. So we'll talk about that. The owner of the property is the investor. And it's the owner or the investor that hires the agent to manage their property. And one thing we're going to learn that the property manager does is help the owner with their money, help the owner not necessarily spend their money, but help the owner understand what money they have coming in, what money they have coming out, if they're making money, losing money, etc. So that's the math that we're going to go into. So let's start page 332. Actually, before we jump to 332, this is a quick reminder. We talked about this back in Unit 8, and the requirements that you need to have a license if you're going to be involved in the transfer of real property for others for compensation. And when we talk about the transfer of real property, we can refer to LL Beans. So what activities are you helping others for compensation? Are you helping others list, lease, buy, exchange, auction, negotiate, or sell? And again, I think the visual that helps is to see our funnel. All three activities are required. So do your head one way or another. If you are helping somebody for compensation manage their property, do you need a real estate license? Do you need a real estate license? Yes, because you're helping somebody else lease real property for others for compensation. Okay. What if you were renting your own property, a property that you owned? Would you need a license? Would you need a license? No, because now you're not doing it for others, are you? You're doing it for yourself. So we've talked about the for sale by owner, the one that goes unrepresented and sells their home without the assistance of a broker. You may also have for rent by owner. So it's only involved that the agent only needs to be involved when you want somebody else to manage your property, and that's when you hire a property manager. So on page 332, property managers, you got to have an active real estate license. You cannot be a provisional broker to be a property manager. Now, please understand, you can work for a property manager as a provisional broker. You can work for a property manager as an unlicensed employee. but you can't hold that title of property manager. And in order to be a property manager, you're going to have that active license. You're not going to be a provisional broker. And you're also going to be operating under a property management agreement. And we'll look a little bit more, talk more about that in just a second. Why don't you guys tell me in the chat? I got a couple cameras not on, so let's make sure everybody's here this morning. Why don't you guys tell me in the chat, yes or no, Y or N? As a property manager, when you meet the owner for the first time, do you need to do your working with real estate agent disclosure? Working with real estate agent disclosure, Y or N? Y or N? Do you need to do your working with real estate agent disclosure? As a property manager, you're meeting the owner for the first time. Do you need to do your working with real estate agent disclosure? It's kind of a trick question, isn't it? I want to see how we did at 9 a.m. on a Tuesday morning. The answer is no. You will remember our working with real estate agent disclosure is only required for sales transactions. So when you're working as a property manager for the owner, you're not involved in a sales transaction. You're involved in the lease transaction. You are helping the owner of the property lease the property. Okay, so it's not required. Working with real estate agent isn't required. As the property manager, your primary function is to help the owner preserve the value of their investment property, also while helping them generate income. Remember, the owner is hiring you to manage their property, and you pretty much have two jobs: help them preserve the value, the property, and to help them generate income. How much rent do we need to collect to pay all the bills, pay the property manager, and anything left over is going to go to the owner, who's also the investor. So the two main roles, and we're going to talk more about the functions and a little bit about the specifics about what those roles are, how we can help the owner manage their property or help the owner invest, earn income from their property. One thing you're going to do as a property manager is help market the property when the tenant moves out. If nobody's living there, nobody's paying rent. If nobody's paying rent, then nobody's making any money. So when the tenant moves out, we need, as a property manager, we need to work to get a new tenant in. So how are you going to market and advertise the property on behalf of the owner to keep a tenant, have a tenant in place? Property manager is going to help budget and control expenses. We're going to talk a little bit about some of the reports that they can provide for the owner in just a second. Again, securing tenants, not just locating them, but if you have a good tenant, what can we do to keep them in place? Property manager will generally be the one that collects rent. They're going to maintain the security deposit, the escrow account for the security deposit. And then the big thing they're going to do is report to the owner. Remember, they're helping to generate income for the owner. So the owner is going to want to see what's happening to their money. Is this property making me money? Is it losing me money? That's what the owner, also the investor, is going to care about. Other things that the property manager could be responsible for, if there's common areas, they may be responsible for maintaining those common areas, keeping them safe. If the property manager has employees, may they be licensed or unlicensed. We're going to talk about unlicensed employees when we get to license law and commission rule a little later this week. So we'll see the specifics about that. Pretty much anything the property manager does is by agreement of the owner that hires them. So when they enter into their property management agreement, they're going to decide, I'm hiring you to do this, this, and this. There are a few things that the property manager can't do or shouldn't do. The property manager can't make capital improvements. A capital improvement is increasing the value of the property. Painting a room is not a capital improvement. Finishing the unfinished basement is a capital improvement. The property manager is not increasing the value. They can make suggestions. They can help the owner save the money to make these capital improvements, but they're not actually making the capital improvements themselves. The property manager can't reinvest the owner's profits. So once that owner's paid what they do with their money, property manager cannot be involved in that. Again, they can make suggestions, but they're not the ones reinvesting. The owner is responsible for paying their own taxes. And then the property manager is not responsible for establishing a depreciation schedule. That would usually be the responsibility of an accountant. They could help the owner determine a depreciation schedule. How much value is it going to lose over how much time? So again, while the relationship between the property manager and the owner is negotiable, this is what I'm going to pay you to do kind of conversation. It's going to all be spelled out in our property management agreement. There are some specific things that the property manager should not do. The owner of the property and the property manager enter into a property management agreement. Please hear me when I say the property management agreement is the agency agreement. This is the relationship that creates OCAR between the licensee and the member of the public, the client. As we have said, an agent, a broker cannot enter into an agency agreement with the owner of a property unless it's in writing. So the property management agreement, the licensee cannot perform a single service for the owner of the property unless that property management agreement's in writing. Same thing with our listing agreement. Good morning. You cannot perform a single service for an owner unless you have a written agreement. This agency agreement establishes the authority of the property manager. It spells out this, as I, the owner, if I'm hiring you, as I, the owner, this is what I'm paying you to do. This is what I expect you to do. It's going to spell out the authority. And one thing that's pretty unique with the property management agreement that we did not see in our listing agreement or our buyer's agency agreement is that it's not uncommon in a property management agreement to allow for an automatic renewal. Remember we said with our listing agreement and our buyer agreement, when it's over, it's over. We have a definite end date. It's over, unless we agree to extend it. But one thing that's unique, that's a little different in property management, is that it can allow for an automatic renewal. In an ideal scenario, the owner and the agent are creating a long-term relationship. So if you hire me for a year to manage your property, and within that year, I'm making you money, I'm keeping a tenant in place, I'm reporting to you, and we have a good relationship, we can just keep continuing that. We can automatic renew it, but we need to have verbiage in our agency agreement. Once the owner and the property manager enter into a property management agreement, the property manager owes the owner OCAR. The owner has hired the broker to perform a service. And what the broker owes the owner is OCAR. Why don't you guys, in a private chat, why don't you guys tell me in a private chat, we talked about classifications of agency. We talked about the universal agent, the general agent, and the specific agent. What is the property manager to the owner? And you can tell me U, G, or S. What is the property manager to the owner? Universal, general, or special? The relationship between the property manager and the owner, universal, general, or special, and you can tell me U, G, or S. I know what you're talking about. Okay. The property manager is a general agent to the owner. So let's go back and refresh those real quick. Universal is full power. Remember, universal is the unicorn of classifications of agency. General agent is some power. You have some ability to make decisions. You have some ability to bind your principal. And special is zero power, zero ability. Special is the relationship between the sales agent and the buyer and the seller. So the general agent is the one that has some ability, some authority to make decisions. How much ability, how much authority, it depends on how we spell out in our property management agreement. But let's think this through for a second. Let's say you have 10 investment properties and you hire me to manage your investment properties. You hire me as a property manager. And let's say I just start calling you every day, 5 times a day. Hey, can I fix this? Hey, the tenant moved out. Can I find another one? Hey, can we do this? Hey, can we do that? At some point, you're going to stop and ask yourself, what the heck am I paying this girl for? You with me? So as the property manager, there's some ability, there's some authority. Again, how much is spelled out in the property management agreement. There might be, for example, something in there that says, the property manager has the authority to make any repairs up to $500, which means if something breaks and it's under $499.99, the property manager can just go do it. They don't have to call the owner and say, can I fix this? Now, if it goes over $500, now we have to have a conversation about it. And that's what we mean by some ability, some authority. So the property manager is a general agent. They owe the owner, the client, OLCAR. Do I have any questions so far? There is a sample property management agreement in Learn Test Pass under the 1112 material. If you want to look through that, it's available for you. If I can direct you guys to page 334. 334 just gives us some bullet points there of some common provisions that can be found in that agency agreement. So we got a description of the property. Where's it located? 123 Main Street, for example. What's our contract period? Are we going to allow for automatic renewal? What's my fee? Guys, please remember, agency agreements are employment contracts. I'm being hired to do a job. You're hiring me using this agency agreement. So we need to spell out in the agency agreement how I'm going to get paid. Is it going to be a flat fee every month? Is it going to be a percentage of rent collected? How is that going to look? How am I going to get paid? We need to talk about the property manager's responsibilities, authority. What do I have the authority to do? Reporting, how I'm going to report the monies to the owner. We'll talk more about reporting in just a second. Responsibilities of the owner. Remember, agency agreements are bilateral contracts. These are two-way streets. So the property manager has duties and responsibilities to the owner. The owner has duties and responsibilities to the property manager. Duties upon termination. Again, this could look a little bit different in property management than it does sale when the agency relationship is over. So in sales, when our agency relationship, if we're expiring today, that means at 11:59 tonight, we're done. In property management, some duties may need to continue after the end of the agency agreement. For example, the tenants have been sending rent to the property manager for the last however many months or years. So the property manager may need to still work with tenants that don't get that message or the second message to make sure that rent gets directed to the appropriate person. How are they going to handle the security deposit? The security deposit's been in the property manager's trust account or escrow account. So when that relationship is over, how are we going to get that security deposit either to the owner or to the next property management? And then there are some miscellaneous provisions there. So again, just A quick idea, we obviously spent more time in our listing agreement, our buyer's agency agreement, but just the bullet points, quick idea of some of the responsibilities, some of the things that we can find in the property management agreement. So flipping over to page 335, let's talk a little bit more about the typical duties that are expected of the property manager. Keep it in mind that anything's negotiable. So when I say typical, these are common, but the owner and the property manager can pretty much agree to do whatever they want to do. One of the big things that the property manager is going to do is prepare a management plan. The plan is going to outline the owner's objectives. Does the owner have a goal? I want to produce X amount in, X amount of time. How can the property manager help the owner achieve their goals and objectives? The property manager is going to assist the owner in doing a market analysis. We need to know the area, know the market, know the neighborhood. What are the trends? Is the neighborhood trending up? Is it trending down? That's absolutely going to affect rent. How much rent we can expect to collect. Do we need to adjust rent periodically? And then they're going to help with the specific property analysis. Remember back in Unit 17, we talked about our CMAs. And we said our CMAs can help us determine probable lease price and probable sales price. So when you're hired as a property manager and the owner looks at you and says, how much rent should I collect? We're not just going to blurt a number out. We're going to do some research. We're going to do a CMA to determine probable lease price and help the owner determine those rental schedules. I think one of the bigger responsibilities of the property manager is helping the owner with their financing, helping the owner see their numbers. And they're going to report to the owner periodically. How often? Is it monthly? Is it quarterly? Is it semi-annually? That depends on the relationship between the owner and the property manager. If the owner wants to see their financial reports once a month, then as the property manager, you're going to provide those reports once a month. So just a couple reports that the property manager may be expected to provide the owner. The operating budget. Budgets are done in advance. Budgets are kind of the prediction of the year to come. So if you sit down, for example, at the first of the year and do your household budget, you're sitting down at the first of the year and you're planning. This is how much money we expect to bring in to the house this year. How can we save? How can we set aside money so we can do our family vacation in the summer, so we can have Christmas, birthday parties, etc. You're budgeting, you're planning ahead, you're planning in advance. Somebody asked about that apartmentguide.com. I would put that in the category like the AVMs. We talked about automated valuation methods. So I'm not exactly sure. I don't know much about apartment.com, but apartmentguide.com. But yeah, same thing with like Zillow and realtor.com. You can find for lease websites as well. And that information is only as accurate as the information provided to it, right? So I think while we can look at that to get an idea, I think the best way to get a good leasing price for this neighborhood, this property, is to study our CMA, study things that we're not looking at recently sold comps now, we're looking at recently leased comps. How much is a tenant willing to pay? And you have access to that in MLS, by the way, too. We have a whole separate section in MLS for lease. There's a section for commercial, there's a section for land. So MLS really kind of breaks down the different categories. So the operating budget is done in advance. We're going to sit down at the beginning of the period and we're going to determine this is how much money we expect to have come in this year. How can we budget? Let's see, in MLS, yes, it only shows rentals that are managed by property managers, those that are members of the Triad MLS. So if you have management out that isn't a member of the MLS, maybe they're doing it for themselves, they wouldn't be an MLS. So same thing with for sale by owner. For sale by owners aren't in MLS typically, so you may not be able to use those as closed comps. Again, you can only work with the information that you have, but it kind of gives you an idea. It kind of gives you an idea. So the operating budget. Another report that the owner may want to see from the property manager is a cash flow report. Cash flow report is a monthly report of incomes, expenses. It's cash flow, money in, money out. So they want to see each month, how much money did I make? How much money did I lose? What's my income? What's my expenses? This cash flow report is going to show your current financial status of the property. Today, you are collecting how much rent. So of that rent, this needs to be paid out for bills, for your management fee. Again, and once everything is paid and whatever's left, that's what the owner gets. Yeah. Income would be credit. Expense would be debit. Income is money coming in on your behalf or a credit. Expenses are money going out, money you owe, or debits. So as we said, income is all money coming in. We talked about your PGI last week, your potential gross income. It's not just your rent. It's what other sources of income do you have? Vending machines, pay phones. Maybe you have a clubhouse membership. Any potential money coming in. Expenses is money going out. Expenses can be fixed or variable. Fixed expenses remain constant whether or not you have a tenant in place or not. Variable expenses can fluctuate depending on whether you have a tenant, maybe the time of year. So for example, fixed expenses, real property taxes. Does Guilford County care if you have a tenant in place paying rent? No. They said, this is my taxes due this year. This is how much I expect to collect. Those are fixed expenses. Variable expenses, maybe more maintenance if you have a tenant in place or not. Landscaping could be variable. You're not using as landscapers as often in February as what you are in August. So that could be a variable expense. Another report that the property manager may report to the owner is something called a profit and loss statement. Profit and loss is just that. What's our revenues? What's our expenses? Think of profit and loss as the current financial picture. Again, how often is the property manager doing this? It depends. It's all in that relationship between the owner and the property manager. Does the owner want this once a month, once a quarter? And at the end of the period, so we did the operating budget at the beginning, right? Try to predict our expenses this year. So at the end of the year, we're going to want to do a budget comparison statement. And what this does is compare the actual results with the original budget. On January 1st, this is what we thought was going to happen. On December 31st, this is what actually happened. And that budget comparison statement can help us do next year's budget. We can kind of compare and contrast. Do we need to make adjustments for next year? Do we need to increase rent? Do we need to rally our expenses? What do we need to do for next year? So on page 337, we're going to talk more specifically about the investor. So remember, the investor is the owner. The investor is the one that owns the property. They hope to invest in the property, make an income off of it. And thinking through the eyes of the investor, You guys remember our cash flow formula? Last week, we learned how to solve for net operating income. Violet, poor Violet eats Oreos nightly. That just gives us the order of the formula, helps us know what goes where. And investors are who cares about net operating income. What's their cash flow? So we started with the PGI, the potential gross income. That's the dream. If I was collecting 100% rent 100% of the time, what's the most I can make off of this income producing property? From that, we deduct our vacancy and collection losses to get our reality, the EGI. The truth is you're not going to have 100% vacancy. Even if the best tenant in the whole world lives there for 20 years, they may move out at some point. You may not have much work to do, but you're still going to have a period of time for when the old tenant leaves to when the new tenant comes in. So the PGI is the dream, the EGI is the reality. From your EGI, you deduct operating expenses, maintenance fees, management fees, specifically property management fees, janitorial fees, taxes, insurance, landscaping, decorating, household expenses. And remember we said last week that operating expenses include everything but your debt service. Operating expenses include just about everything but your operating expenses. I'm sorry, your debt service. And your debt service is your money that you owe the bank, right? Your principal and your interest. So we figure out our annual operating expenses, deduct that from our EGI to get our net operating income. To take this formula a step further, once you have your net operating income, now when you deduct your principal and interest, what the investor is left with is their before tax cash flow. So through the eyes of the investor, same process of finding the net operating income. Once we have the net operating income, then you deduct your debt service to get your before tax cash flow. Before tax cash flow tells the investor how much money do you have before you pay your taxes. So our monthly debt service, or annual, in this problem, from our before tax cash flow, we pay our taxes, and then the investor is left with something called after tax cash flow. So that formula that we learned last week, net operating income, deduct your debt service, before tax cash flow minus your taxes. Question comes in, will you see a math problem on this? I doubt it. You will need to find the net operating income. You may need to understand, when do taxes get paid? So your net operating income, this is when you deduct your tax, your debt service. Questions? As an investor, could you have negative cash flow? Could you owe more than what you're collecting? Absolutely. Absolutely. And it's not uncommon for the first couple years of an investment property to be in the red. But hopefully as an investor, you start to see those numbers come up a little bit. A question comes in, does the property manager deal with sending rent to the mortgage company? That may be an agreement between the owner and the property manager, but typically I would consider that an owner responsibility. But it's not one of those things that the property manager isn't allowed to do. So if the owner says, here's my mortgage information, just pay my bill for me, then they could agree to do that. But I would think as the owner, I'd want my finger on that pulse, but that could be an agreement between them. Okay. Another thing the investor cares about is leverage. Have you guys ever heard the expression, it takes money to make money? It takes money to make money. That's the idea of leverage. Leverage is the idea of using borrowed money to help with your investment. Remember, your debt service is your mortgage payment, your principal and interest, not your taxes and insurance, just your principal and insurance. So if you are using that leverage, that helps to reduce your taxes. From your net operating income, you take your debt service. You could have lower mortgage payments spread out over a long period of time that could result in a higher cash flow because you're not paying as much into that debt service. So some investors, even though they could buy investment properties in cash, some do just pay cash. Others use this idea of leverage, help use that mortgage payment, that borrowed money to increase their cash flow up front till they can get themselves up and running and their expenses going. Another thing that the investor cares about is something called equity buildup. And first off, let's understand what equity is. Equity is value, what is the property worth minus debt. Equity is just value minus debt. So let's say, for example, your investment property is valued at $100,000 and you take out an $80,000 loan. What's the debt? When I refer to debt, we're referring to what you owe the bank. So the property is valued at $100,000, you take out an $80,000 loan, you start with $20,000 in equity. Equity is your money. Equity is the money that you have in the property, not what the bank has in the property, but what you have in the property. So the three ways to build equity revolve around value and debt. How you build equity is about increasing your value and decreasing your debt. Specifically, the three ways. If you want to increase your value, you could pay off your principal, owe less to the bank. I'm sorry, that's decreasing. I'm sorry, forget what I just said. Increasing your value, appreciation. Appreciation would increase the value. If we said depreciation is the decrease in value, then appreciation is the increase in value. A lot of properties in this market, this crazy seller's market we're in, have seen appreciation. The values have gone up. That increases your equity. Capital improvements can increase your value, thus increasing your equity. Again, we said capital improvements is adding value. Painting a room does not increase value, does not add value. Building a room on the back of the home, adding an extension, that's a capital improvement. So the two ways you build your value, appreciation, capital improvement. And then the third way to build equity is to pay off your debt. Pay off the principal, pay off what you owe the bank. Again, equity all revolves around value versus debt. We'll see this. We'll do a little bit more with this formula in just a bit when we look at our Unit 12 math. So we got that written down. Value minus debt equals equity. Questions? Page, where are we? Page 338. It's just some typical property management duties. Again, they need to rent the property. When the tenant moves out, we need to get a new tenant in as soon as we can. What do we need to do to fix the property or get the property ready for the next tenant and get a new tenant in? We talked about the Residential Rental Agreement Act in Unit 11. We also talked about the Tenant Security Deposit Act in Unit 11. So the property manager is expected to follow both acts. when dealing with tenants, when dealing with the public. The tenant is the public, which, by the way, I'm not sure that we mentioned this, but let's make sure we do. The owner hires the property manager. The property manager owns old car to the owner. The tenant is not their client. The tenant is their customer. You remember what we owe our customer? Honesty, fairness, and the disclosure of material facts. The owner gets old car. The tenant gets honesty, fairness, disclosure, material facts. And the property manager has to follow the rental rules, Residential Rental Act and Tenant Security Deposit Act that we talked about last week in Unit 11. The property manager is going to help the owner establish a rental schedule. We need to make sure that we're collecting enough rent to pay the bills, pay me, but also get some money in the investor's pocket. So how much rent can we collect? Well, we're doing our CMAs, we're doing our research, we're studying the market, we're familiar with the market. Rent needs to be fair for both parties. One thing that is affected by off rental rates is vacancy. If you have high vacancy, it may be that rent's too high. It may also mean that there's property with the management, right? Could be problems with the property. So it's not always, high vacancy doesn't always mean that rent's too high. It's just one thing to take into consideration when trying to figure out how we can get a tenant in. Why has this unit been sitting empty? The property manager is going to help market the property. Again, when the tenant moves out, how are they going to market and advertise? Are they going to put a for rent sign in the yard? Are they going to put an ad in various websites, social media? All that's in an agreement between the property manager and the owner. Qualifying and selecting tenants. Property manager needs to be really careful when dealing with tenants. We just said that they are their customer, and the property manager needs to make sure that they don't cross the line between customer and client. They can't have that implied agency. The tenant is calling the property manager for everything, right? They may not even know who the owner is. The only thing they know is who the property manager is. So the tenant doesn't understand that relationship. They just know that this is their person, their go-to person. So the property manager has to walk a pretty fine line between old car for their client, the owner, and creating, we want long-term relationships with tenants. We want them to stay and pay. But they need to make sure they don't cross that line. And when the property manager is selecting tenants, they're working to get a tenant in place, obviously, but they also need to make sure that the space is adequate for the tenant. That's how we create long-term tenancies. So does the size fit the tenant's need? Does the property itself? If it's a commercial tenant, is their business allowed in this business park or this office park? Does the tenant have the ability to pay? Do we need to do a credit check? One thing we're getting ready to learn in fair housing, what you do for one, you do for all. So if you do a credit check for one tenant applicant, you do a credit check for all tenant applicants. And another thing that the property manager and the tenant may want to take into consideration when selecting tenant, again, if it's a commercial tenant, does the commercial tenant plan to expand, plan to grow in the future? And if so, do we have a space? Do we have the availability for them to grow? So the property manager, again, they're communicating with relationships with the tenant, but you need to keep in mind that it's the owner that gets old car. So what you do in selecting the tenant is in the benefit for your client, for your principal. The property manager is going to be the one that collects rent. They're going to be maintaining the security deposit. Property managers, if they're collecting security deposits, they have to have an escrow or a trust account. We'll see that in license law and commission rule. The property manager is going to be the one that's responsible for maintaining the property. Costs, repairs. Is it something minor? Is it something major? Did the HVAC system go out in August? Again, the tenant is the one communicating with property manager. When it comes to maintaining the property, your book spells out, I'm just going to point this out on page 341. There's a couple different areas of maintenance that the property manager should consider and the owner should consider. You got your preventative maintenance. This is just your regularly scheduled activities. The house needs painted every once in a while, for example. Repair corrective maintenance. This is when something actually breaks. Repair corrective. So is the faucet leaking? Did the HVAC system go out? Did the water heater bust? Routine maintenance is just your day-to-day activities, maintaining the common areas, making sure the furnace filters are changed, for example. And then constructive maintenance is your upfitting, your construction. Maybe it's time to update the bathrooms or the kitchen. Maybe if it's a commercial property, maybe there's an upfitting allowance, an upfitting space. The property manager has to be concerned that the tenant is not abusing environmental issues. I think this falls more into place with commercial properties than it does residential, but absolutely it applies to residential as well. I think we talked last week, every once in a while you hear a story about a restaurant that dumps their grease in the creek behind the restaurant. That's an environmental concern. We can agree on that, right? That's an environmental concern. And if the tenant is dumping the grease in the creek out back, the enforcement is not contacting the tenant. They're not contacting the property manager. Who do they have to contact? The only person they know to contact is the owner. So when the owner gets a call that grease is being dumped in the creek out back, do you have a happy owner? Do you have a happy client on your hand? Absolutely not. So the property manager is going to be the one responsible for making sure that the tenant is properly addressing any environmental concerns. And then the property manager is also responsible for making sure that the property abides by Americans with Disability Act, or ADA. We talked briefly about this last week. ADA is, let's see, ADA is applicable to public places. Any place that the public can access. And what ADA says is that anybody, regardless of their handicap or disability, should have the same access to public spaces as everybody else. ADA applies to any employer with 15 or more employees. ADA is for any employer with 15 or more employees. And those employers, those public places that have 15 or more employees, again, ADA says you need to make reasonable accommodations. Anybody should have the same access, the same ability to your public space as anybody else. ADA distinguishes between accommodations and modifications. An accommodation is a change to the procedures. A modification is a change to the building itself. So let's say there's a public place, an employer that has a second story office, and this building was built like back in the 60s and it doesn't have an elevator in it. ADA is not going to make that employer add an elevator. They're not going to make them modify the building. They're just going to have to make it accommodable for those that can't access a second floor. Maybe we have a space downstairs where somebody can come meet you. Maybe we have more handicap parking spaces, for example. Now, when that building does want to do major renovations, or if they want to do demolition and rebuild, today, part of building code is that a building will have an elevator or have access to the second story. So let's make sure we're good. They're going to make you do accommodations. They're not going to make you do modifications until you are ready to do major modifications or major work. Anything happening today, anything being built or major renovations today will have to meet ADA codes. We also talked last week about service animals. ADA currently recognizes service animals as dogs. So if you're an employer with 15 or more employees, you cannot not allow a service dog into your establishment. You don't have to allow anything else in, because anything else is an emotional support animal or an assistant animal, but you cannot deny access as an employer. You cannot deny access to service animals. If somebody wants to come into your place of employment with a service animal, you can't ask a lot of questions like, what's wrong? Why do you have this dog? You can ask, does this service animal aid in your disability or handicap? You can ask very basic, but you cannot look at the individual and say, what's wrong with you? Why do you have this dog? If you allow the service animal access into your public place and that service animal starts acting up, starts jumping up and down on other customers, maybe piddles on the floor, that's not how a service animal acts. So once the service animal is in your place of employment, if they stop acting like a service animal, you can ask them to leave. It's unfortunate. It's really sad how many people take advantage of this. I mean, guys, let's face it, you could probably go to Amazon and get a service animal vest for your dog. But just because you put a service animal vest on them doesn't mean that they are a service animal. Service animals are trained to act in a way that's best for their owner. They're servicing their owner. Some places may require documentation. I'm not sure how ADA would feel about that. I'll let you guys defer, I guess, to your experience on that. But from what I understand, from what we're always taught in CE classes, is that you're very limited. You can't demand documentation. You can't, what you can say is, does this animal accommodate your disability? And if the employer is told yes, they cannot deny access. So there's what we know and there's what we may be tested on. And I'm not trying to dispute. This is what the Real Estate Commission says. And what I understand, what they tell us is you cannot demand to see that documentation. You can ask, does this service animal accommodate you? Provide a service for you? And if they say yes, you can't deny access. Once that dog gets in and starts acting up, then you can ask them to leave. That's right. The employer has to protect their building. ADA, 15 or more employees. You guys got that? So if you have 14 employees, do you have to abide by ADA? Do you have to make accommodations and modifications? Do you have to allow a service animal in? If you have 8 employees, no, ADA only applies 15 or more employees. Other questions?
And are you saying like ADA concerning the employees for 15 or more, or just the general population of
The
15?
employees,
Um,
any employer with 15 or more employees. Yep, has to abide by ADA. Okay. All right, let's go ahead and take our break. Only about 2 more slides left in Unit 12, and then we're going to do our math for Unit 12. Let's take 10. All right. Are we back? Cameras are on. Okay. So we are taking attendance. And just so we're clear, we're actually going to see ADA again in just a minute when we look at fair housing. But the thing that we need to understand, one of the big things that we need to understand, ADA is about the public places. We're going to learn in just a minute that fair housing picks up where the public left off. Fair housing is about the dwelling, the unit. So ADA is about the public, fair housing, we will learn, is about the unit. And again, if you're a property manager in a large apartment complex, you got both, right? You got to make sure that all your common areas, your common spaces abide by ADA. And you also need to make sure that the dwelling itself abides to fair housing. So we will see this again in just a minute. If you're just coming back, I have already taken attendance, so please make sure you let me know. So ADA, do you have any questions, basic questions on ADA? Again, they're not going to make the employer do major modifications. They're not going to make them put in an elevator. They will make them do accommodations to their practices until they're ready to do major renovations or demolition. Then they'll have to rebuild with an elevator. Does that make sense? They want to be reasonable, but they're not trying to put anybody out.
Julie,
Yes.
just real quick on the 15 employees, like let's say you have a landscaping company that's contracted to take care of the grounds. Are people that are contracted to come in and do work, are they considered an employee, or is it just the on-site?
Just the on-site,
Like,
the people that you hire and manage. So that landscaper in that case would be like a subcontractor. You're subcontracting
Gotcha.
that work to
Okay.
the, that's a good question. Thank you.
Thank
So
you.
it's who the public place hires, right? Who's on their payroll for their
Okay.
employee. And again, you guys, not everybody's going to fall under ADA. It depends on how many employers you have. Yep, and I'm seeing several cameras on, so let's make sure. Thank you. Make sure I know you're here, please. Okay. The last little piece of this is what kind of risk that property managers need to consider. And anytime we talk about risk management, we're just answering the question, what'll happen if something goes wrong? Is something bound to go wrong? Is something bound to go wrong at some point? Sure. I mean, things just happen, right? So the property manager needs to have some risk management in place and just some possible solutions for that risk. They could try to avoid the risk, just flat out remove the source of it. What is the risk? What is the danger? Let's just avoid it by removing it. They can retain it by putting maybe a deductible in their insurance policy. Just a little side note. They can control it, maybe preventative measures, or they can transfer it. Transfer it would just be taking out a whole separate policy just for that. So I can either add it to my existing policy and retain it, or I can just transfer that liability, let somebody else deal with it, take out a whole different policy on that. Again, when it comes to insurance, the insurance is in the owner's name. So the property manager, before they get any kind of insurance policy or deductible on it, they need to make sure that they have the owners okay. These are all conversations that the property manager has with the owner, with their client. Questions? We weren't kidding when we said 12 was, it's another short, sweet, and to the point unit. Guys, please remember, I've had students take this test before and come back and say, there were more questions on property management than what I expected. And I think a big reason for that is a lot of times we sit here and tend to think, I'm not going into property management. Why do I care about this? And my answer to why you care about this is because we got to get you through the tests. Fair enough. So pretend like you care about property management until you get your license. And then unless that's the field you're going, you don't need to worry about it. So your key terms are at the beginning of unit 12 on page 331. We are getting ready to look at some math. It's not in unit 12. We'll explain that in a second. Key point review on 346. And then your student quiz on 348. I do want to point out the math that's in unit 12. It starts on page 345. This is how the property manager can get paid, property management fee. And we're not going to go through this, but just to point it out so you guys know that it's there. Remember, as a sales agent, you typically got paid a percentage of the sales price, whatever that the firm agreed to, percent of the sales price. Usually as a property manager, one way you can be paid is a percentage of rent collected. So however much rent you're bringing in, one way to pay your property manager is to pay them a percentage of rent collected. So if we're not collecting rent, is anybody making any money? Because what's 10% of zero? Zero. It's called one in Learn Test Pass. Everything at the end is called 100%. You got some good quizzes down there. You got our end of course review. I'll try to point all that out again today after class. But it's in Learn Test Pass. It's this whole little category called 100%. Anybody get a chance to look at that this weekend? Start planning ahead. Somebody reminded us when we logged on this morning that, I mean, y'all know what you're doing in 1 week from today, right? So hopefully you started looking at that 100% stuff in Learn Test Pass. If not, it's okay. Breathe. You got a week. Okay. So the math in unit 12, here's the story behind it. It used to be in another unit and then they took it out and then they didn't really put it back in. So I'll tell you guys, because I do need to stop sharing so I can switch out my PowerPoint. So bear with me just 1 second. The math that we're getting ready to do in unit 12 is our investors math. So we're going to talk about the math that the investors care about. Have you guys noticed yet? And I didn't, somebody had to point it out to me because I just never ever look here. Have you guys noticed there are formulas on the front cover and the back cover of your textbook? Have you guys seen that yet? Of all the places to put formulas, who looks at the cover, right? So of all the places to put formulas, so some of the math we're going to look at is in the front cover. On that front cover, you see a little bit of math about percent of equity increase in the second column. That's some of the math that we're getting ready to do. And then in the back cover, there's a little section there on profit and loss. You do have some examples in your book. I'll show you, of course, where you can get those in just a second. And of course, I got stuff for you guys in Learn Test Pass as well. But where we're heading next is to talk about some profit and loss math and some equity math. Again, this is investors math. This helps the investor determine what's happening to their money. Where's their money going? So let's back up. Let's go back to what was that, like class 2? I introduced you guys to the T-bar. Have I converted anybody yet? Do I have any T-bar fans out there? Yay, I see some hands. That's my whole goal for the class, is to get you guys onto the T-bar. If you're not, that's okay. Look, everybody's brain sees things differently, don't they? So if the T-bar isn't for you, but hopefully we can start kind of at least getting you thinking how the T-bar works. And you'll remember when we first introduced the T-bar, T-bar 101 told us that we're looking at the part and the whole. Julie said the rate or percent always goes where? What has Julie been babbling on about the rate or the percent? It always goes in the bottom right, and it's still going to apply to that now. But the two major components, we've been looking at commission as part of sales price, for example, seller's debits as part of sales price. That's T-bar 101. This is where we've been. And up until today, one easy way to decide between the part and the whole is when you're studying those two numbers, such as commission and sales price, the number that goes on top is the smaller number, right? This is pretty much what we've seen up until this point. The part is smaller than the whole. We're going to see some cases today where you may have the part that's bigger than the whole. The number on top is going to be bigger than the number on the bottom left. So when would that case be? What would that look like? And what we're going to learn in just a bit, when your number on your percentage number, when the number on your bottom right is more than 100, you have something more than 100%, 110%, 130%. Your percentage is more than a number. And those are going to be cases when the number on top is bigger than the number on the bottom left. So with that in mind, let's keep that tucked in the back of our mind as we go through these. The first little piece of math that we're going to do, investor math that we're going to do, is we're going to look at some profit and loss math. How can the investor determine if they're making money or losing money? And the first piece of profit and loss math that we're going to consider is percentage of profit or loss. Please take just a minute to write this formula down, this T-bar down, and then we'll talk about it. So this T-bar gives us our percentage of profit or loss. The bottom left is the amount paid. That's the original amount that you paid for it. When you bought this investment property or you invested in this, what was your original cost? That's our amount paid in the bottom left. Of course, your percentage on the right, there's your percentage of profit or your percentage of loss. But let's talk about what this amount made means, the number on top. If I give you $100, I don't know why, I just give you $100, here you go. And somewhere down the road, you give me back 125. I give you 100, you turn around and give me 125. How much did I actually make? Did I make $125? No, because 100 of that was my original investment, right? So my amount made, the number on top is going to be the difference in my original cost minus what I actually received. The amount made is the difference in what I paid for it versus what I actually sold it for. If I give you $100 and you give me back 125, I only made $25 because that $100 was my original cost. Questions on this? Everybody with me? Good so far? The amount made is how much I actually earned. And it's the difference in what I paid for it and what I got back, what I sold it for. So we're going to do one of these together. And then, of course, I'm going to let you have some fun too and do one on your own. So let's look at our one together. If Rachel buys a property for $38,000, sells it for $62,000, question wants to know what is her percent of profit. We know that when we're dealing with percent of profit, we can use the T-bar. And in this case, what I'm solving for is, the question wants to know what the percent is. And Julie says, what am I doing? Julie says the percent always goes in the bottom right. So what we're solving for is the bottom right. Let's look at our amount paid first, bottom left first. She bought the property for $38,000. Can we all agree that $38,000 was her original expense? That's what she used to purchase the property. That was her original expense. That's her amount paid. How much did she pay for it? $38,000. The number that's going to go on top is the difference in what she bought it for and what she sold it for. So she sold it for $62,000. She bought it for $38,000. So the difference of $24,000 is her amount made. Does everybody see that? She paid 38. She sold it for 62. How much did Rachel make? $24,000. Her amount made is the difference in what she bought it for and what she sold it for. Our back fourth line means what? Back fourth line means divide. You take 24,000 divided by 38,000. And we get, on your calculator, you get a number that looks like this, right? Big, long number, right? That's your rate. To convert that to a decimal, you just move it over 2 places to the right. So she would have a percentage of profit of roughly 63%, 63.16%, something like that. Amount made as part of amount paid. Questions on this? Okay. All right, y'all's turn. Here's a problem. You guys take just a few minutes. Share your answer with me in a private chat. I'll give you a couple minutes and then we'll talk about it. Give you about 30 more seconds, and then we'll talk about it. I was asked to wait. Okay, we good? Okay. You buy a property for 72,000 and sell it for 69,000. Do you have a loss? You bought it for 72, you sold it for 69. You sold it for less than what you paid for it. So without even doing the math, picking up a calculator, we know we have a loss, right? If you have a profit, then you would have sold it for more than 72,000. You want to break even, sell it for $72,000. What's your break even point is what you pay for it. So again, without ever picking up a calculator, sometimes just analyzing the problem, right, will kind of help you know what kind of direction you're heading. So we know we have a loss, even if it didn't ask me, we know we have a loss. Again, what I'm solving for is the percentage. So my X is the number in the bottom, the right. Bottom left is what you paid for it. So you bought the property for $72,000. And now what we need to do is compare. What we're doing is comparing the difference with what you paid for it. So your amount made is the difference in what you paid for it and what you sold it for. So you have a loss of $3,000. And by finding that difference, by finding that amount made, it allows you to just actually study what you made or lost versus what you actually paid for it. Our back fourth line means divide. So 3,000 divided by 72 gives us a number that looks like this, 416666. If we move our decimal over 2 places, we can see that we have a loss of 4.17%. We've already determined we had a loss because you sold it for less than what you paid for it. How much of a loss? 4.17%. Good. Yeah, and you guys remember, don't get so bogged down on rounding. You're not going to miss. So in other words, you're not going to have an answer choice that's like 4.16% and then 4.17%, right? I mean, they're mean, but they're not cruel. So they're not going to have answer choices if rounding alone. Somebody just said it perfectly. Y'all stop doubting yourselves. I'm still getting question marks in my answers. Questions on this: percentage of profit or percentage of loss? If you rounded differently than me, again, if you got 4.16, you'll be able to look at the answer choice and know that you're close enough to 4.17. Okay. Good. I love seeing that too, when you see what you did wrong. That's how we learn. That helps, doesn't it? It's easier for you to see it, you to find it, less likely to make that mistake, whatever that was. So if you didn't get it right the first time, my question to you is, do you see now where you went wrong? Somebody else commented on their fat fingers. Yeah, y'all, if you're calculating, there's a reason mine's not any smaller, because my big old clunky fingers get in the way. So if you're finding your fingers are getting in the way, you got less than a week to go calculator shopping. Make sure you have a calculator you're comfortable using by next week. Okay. Yeah, they got calculators that are like size of your book. Yeah, that's what I'm talking about. The numbers are like this big. They're hard to miss, but still be careful because it's still doable. Okay. So profit or percentage of loss, percentage of profit or percentage of loss is one piece of profit and loss math. Another piece is looking at the present value and the original value. And again, our T-bar puts the present value on top, original value on the bottom. The percentage that we're looking at this point is the percentage of the seller's cost. You would still get the same 4.17. So present value is part of original value. Present value is what it's worth today. Original value is what it was worth back in the day when you bought it. So what was it worth back in the day versus what is it worth today? Present value is part of original value. And that's going to tell us what the percentage of the seller's cost was. These are the problems when we're talking about present value, original value. These are the problems where we're going to start seeing the part bigger than the whole. Remember, we just said, when is the part bigger than the whole? When the percentage is more than 100. So when we're doing these problems, I actually want you guys to think of 100 as your starting off point. When you count, you always start with 100. The 100% represents your original value. How much did you put into it? If you have a profit, you're going to have a number more than 100%. You're going to start with 100 and add to it. If you have a loss, you're going to have a number less than 100%. You're going to start with 100 and deduct. But we're going to think of 100 as our starting off point, because 100% is your original value, what you put into it. If your present value is the same as your original value, you broke even. You didn't have a profit or a loss. So 100 is our starting off point. More than 100 is a profit, less than 100 is a loss. So we're going to look at one together, and then I'll let you guys do one. So this one says a home is listed for $285,000, sold for $275,000, and gave the seller 10% profit over the seller's cost. What was the seller's cost? So what we're asking for in this problem, what we're solving for, is their original value. What did they pay for it? So in this case, this is our X, the number on the bottom left. I got a list price for $285 and a sold price for $275. Does the list price matter? Is the value determined whatsoever on the list price? Not at all. So there's your distractor. Because what we care about is what the property sold for. That tells us what buyer was willing to pay for that property. Do I have everybody? Just because the seller wanted $285 doesn't determine the value, doesn't determine what a buyer was willing to pay for it. So our present value, what is it worth today? $275,000. Now let's talk about that percentage, that number on bottom. If we think of 100 as our starting off point, 100 because that's where you started, that's what you invested in it. And the problem tells us that we have a 10% profit. So if we start counting at 100 and I add 10 to it, the number that's going to go in the bottom right is 110%. You had a profit. You had a number more than 100. We started at 100 because that was your investment. I don't know what you could pay for it yet, do I? That's what we're trying to find. I can tell you what it's worth today, and I can tell you had a 10% profit. That fourth line means divide. So you take 275,000 divided by 110%, and we get an original cost. What did you pay for this property? $250,000. Your original cost, your original investment was $250,000. You had a profit, so you know your present value is more. It's got to be more than 100. How much more? Specifically 10%. Questions? Part over the whole. Part is the number on top. Whole is the number on the bottom left. Julie says the rate or percent always goes where? I wish I had a better absolute word for always. Always, always, always it goes in the bottom right. When you guys see rate or percent, you're trying to figure out T-bar placement. That's the easy, you don't even think about that. So part over the whole. And in this case, we're looking at present value is the number on top, present values on top. Original value is the bottom left. Okay. Your turn. Take just a few minutes. Tell me your answer in a private chat, and then we'll talk about it. I'm going to say no question marks this round, okay? I like explanation points. Give about 30 more seconds. Thank you. Okay. So let's see what we got. Stacy invested in a mountain cabin a few years ago, made no improvements to the property. She just sold the cabin for $80,640, losing 16% of her investment. What did the cabin cost, Stacy? Stop. Before you ever pick up a calculator, is your answer going to be more than or less than $80,640? If she had a loss, that means she paid more for it than what she sold it for, right? So A, B, C, or D, you have 4 choices. And one of those answer choices is less than 80,640. You can rule that one out before you ever touch a calculator. So again, read the problem, analyze, look at, study the problem, maybe rule out an answer choice. You get a 25% chance with 4, you get a 33% chance with 3. Everybody with me? You want to go to Vegas on 25% odds or 33% odds? Okay. So before you ever pick up a calculator, you know your answer has got to be more than $80,640. So I have everybody so far. So now we can pick up our pencil. Let's look at our T-bar. I know what I'm solving for. The problem wants to know, what did the cabin cost Stacy? So what we're looking for is that original cost. How much did Stacy pay for it back in the day? Today, it's worth $80,640. What's the present value? Well, if she recently sold it for $80,640, this is what it's worth today. And then the last piece of this is to figure out our percentage. And we're going to use 100 as our starting off point. 100% is her original value, what she paid for, what she invested in it. So if she had a loss, is our percentage going to be more than or less than 100%? It's going to be less than, because we start at 100 and we work down, whatever way, I don't know. I think I'm mirrored image to you guys. So you start at 100 and you deduct 100% minus, and in this case, 16%. So 100 minus 16 gives us 84%. Everybody, let's stop, make sure, do we have questions on where we got the 84%? Kind of goes against everything you were taught when you were learning how to count, right? They always told you start counting at a 0. 0, 1, 2, 3. I'm telling you, in these cases, we're going to deduct it from 100. We're going to think of 100 as our starting off point, because 100 is Stacy's starting off point, right? That was her original investment. That was money that came out of her pocket. So anything more than that is a profit. Anything less than that is a loss. 100% is break even. That fourth line means divide. You take 80,640, divide it by 84%. How much did Stacy pay for that cabin? That original value, that original cost was $96,000. Yep. Questions? Yay. Yay. Again, I ask you, if you didn't get it, do you see where you went wrong? Because that's how we learn, you guys. The other way we learn is I got to wean you off me. It kind of looks easy when I do it, right? So the true test is, can you do it without me? And that's why we got practice, practice, practice for you. Okay. The last little piece of investors math, is to talk about equity increase or equity loss. Why don't you guys remind me in a chat, how do I solve for equity? Go back through your notes. Remind me in a chat, how do I solve for equity? How do I find equity? How do we solve for equity? So equity. Equity is composed of two pieces. What are the two pieces of equity? Value and debt. So how do we solve for equity? Whoops. We take our value minus debt, and that gives us equity. You're going to need to know how to find equity to do these next problems. It's way too easy to give you equity. So you're going to need to know how to find equity. So does everybody have this written down? Value minus debt is equity. And once we find equity, we can use a T-bar. You guys jot it down and then we'll talk about it. So remember what we said earlier, value minus debt gives us equity. We talked about specifically a little bit ago about equity buildup. How do you build your equity? You either increase your value or decrease your debt. How do you increase value? You have appreciation of the property, it gains value, or you do capital improvement. How do you pay off your debt? You pay your mortgage down, you pay down that principal, you pay what you owe the bank. So 3 ways to build your equity. If you guys saw the amount made as part of amount paid formula, T-bar, we're pretty much saying the same thing here. How do you find the difference in equity, the percentage of equity increase or decrease? You got to first study your original equity. What was your equity back in the day, bottom left? What was your equity back in the day when you purchased the property? And you're going to compare that to your change in equity, the difference in your equity then and your equity now. Again, if you saw, keep this simple, if you saw the amount made as part of amount paid, I'm pretty much saying the same thing. I'm just throwing in the new big fancy word equity. So we're going to find the difference for the number on top and compare it to your original. And that's going to give you your percentage of equity increase or decrease. Could you lose equity? Could you end up owing more than the property is worth? Hopefully we have an increase, but you could have a decrease. So again, we're going to do one together. Actually, we're going to take a break and then we're going to do one together and then we're going to let you do one. So if you guys have this written down, I just don't want to go over break time. So let's go ahead and take 10. We come back, we'll do some equity math.
Hey, Julie.
Yeah.
Hey. So I was running a little low on my color coded flashcards
Mhm.
on the yellow and the blue. And I let my sweet husband know this. So there's no more flashcards in the store.
So if everybody goes out looking for color-coded flashcards this afternoon,
No
you know-
more.
and don't blame Susan, right? Blame Susan's sweet husband that jumped on it when he
Right.
saw that there was a need. So- Isn't that funny? We get our systems, right? And that's good that we have that study routine, that system. That's funny.
So I'll mail or drop some off to somebody if they need some.
Oh, did y'all hear that? Careful, we're all over the state, Susan, so be very careful about that. You
Oh,
might be
that's
driving to
true.
Wilmington this afternoon.
Road trip.
Are you going to hand deliver those and fill them out for us? Go on and fill them out too.
Okay. Are you on the coast at the beach? Or... Yeah, I will.
Just remember, we also got Amazon too, right?
That's true.
All right, let's see. So we are back. Cameras are on. Oh. And we are taking attendance. Okay, so equity is value minus debt. Again, you guys, they're not going to give you equity. You're going to have to find equity. Specifically, you're going to have to find your equity from back in the day when you purchased the equity, which is your original equity. And then you're going to have to find the equity for today and then compare your new equity to your old equity. So everybody have this formula jotted down. Again, make yourself a note. If you saw the amount made as part of amount paid, we're saying the same thing here. We're looking for the change in equity as part of the original equity. So we're going to do one together and then we'll let you do one. So property is valued today at $50,000, has an outstanding loan of $45,000. Later, the property is valued at $60,000. The loan is paid down to $38,000. The question wants to know, what is the percentage of equity? One thing I, typically, not always, but typically when it comes to math, I generally like to start with where I want to end. And what I mean by that is to first identify your X. What is the problem asking? What are you solving for? So this problem wants to know what the percentage of equity is, in this case, increase. Where's Julie say the rate or percent always goes? Always, always in the bottom right. So we've identified our X. So the first thing we want to do is study or find our original equity. Is that right? O-R-I-G, original equity. So to find our original equity, first we have to look at the difference in value minus debt originally. So this says a property is valued today at $50,000 with an outstanding loan of $45,000. So value minus debt gives me equity, original equity of $5,000. Step one is to find my original equity. Original equity, in this case today, 50,000 minus 45. That 5,000 is what goes in the bottom left. Questions so far? Next, we need to study our new equity. So later, which tells us today's the original, later's the new. Later, we're told the value has increased. It's now $60,000. Maybe it appreciated, maybe you did a capital improvement, but somehow you've increased the value. And now or later, your debt is $38,000. You've paid that loan down. You've paid that mortgage down. So your new equity, value minus debt, is going to be $22,000. So we found our original equity. What was the equity today? Versus to the new equity, what the equity is later. So the number that goes on top is the difference in the original or the new equity, excuse me. The difference in that, whoops, and your original equity. So the difference in equities, if you will, is $17,000. That's what that number on top is the difference in equities. That fourth line means divide. So you take 17,000 divided by 5,000. And on your calculator, you get a rate of 3.4. How do you convert rate to percent? You move the decimal over 2 places. So 3.4 rate shakes out to equity, change in equity of 340%. The difference in equity divided by your original equity. I think the key to these, you got to find equity. It's not going to give you equity. So you have to first find equity. Questions? After the test. Tally up. Okay. Questions? Equity increase, equity decrease. Okay. So here's one for you guys. Tell me in a private chat what you think McKinsey's percent of equity increase is. Do about 30 more seconds. We'll talk about it. And others. Okay. So what do we got here? Mackenzie bought a home 5 years ago for 220,000. She had a loan of 176. Now the home is worth 260 and her loan is down to 162. The question wants to know, what is her percent of equity increase? I think it's helpful for the most part if the first thing we do is identify what is the problem asking. Identify your X so you can keep your focus. If it doesn't help you get to X, then you don't care about it. That's how we rule out distractors. So now we need to study our equities. So let's first talk about our original equity. Our original equity in this case was 5 years ago. So the value was 220,000. Her loan amount was 176. So the original equity, Mackenzie's original equity is 44,000. Original equity goes bottom left. Questions on how I found original equity. Questions on how I can find that number in the bottom left. Value minus debt. Okay. Now let's find the new equity. What is the equity today? So now the home is worth 260,000. Value is 260. She's got her loan paid down to 162. So what's the difference? What's the change? Or the difference, I should say, is 98,000. My original equity was 44,000. My new equity is 98,000. The number that goes on top is the difference of the two. So 98,000 minus 44,000 gives me a change in equity of $54,000. 54 goes on top. That fourth line means divide. So 54,000 divided by 44 gives us a number that looks like this. 72727. That's where mine ends. That's the rate. How do you convert rate to a percent? Move it over 2 decimal places. So we got 122.7273 or 123%. If you said 123, again, you'll be able to look at 122.73 and know that that's your 173 is close enough. And that's what we mean by you can't miss by rounding alone. They're not going to give you 122.73 as an option and 123. That's what we say. So if you're off by a few cents, it's because of rounding. So what's her change in equity? Percent of equity increase? This case, it's 122, 123%. Amount made is part of amount paid. What's the change versus the original? And we're pretty much saying the same thing in both of those problems. Questions? Good. A loss, these could just be like your debt would be more than your value. So you'd have negative equity. The formula would still be the same. You're just now looking for percent of equity loss. Your debits would be more than the value. So you would have negative equity. You're losing money. Again, equity is the money that you have invested. There's the money you owe the bank and there's your money. And that's what we're determining with equity. That's what that equity is, value minus loss. Yep. So if you owe more than the property's worth, you don't have anything invested. You have negative equity. So even though this math isn't really spelled out in your book, they still got some practice problems for you. Again, this math used to be in Unit 18, and they didn't take it out of Unit 18. So on page 474, numbers 15, 16, and 17 are investors. Remember, this is investor math. And then there's those 50 problems in the back of the book, pages 803 to 808. These are the numbers that relate to the math that we just did. And we have some in Learn Test Pass as well. I'll show you that in just a second. So page 474. And then pages 803 to 808. Okay. Can I get out of this? Everybody have these numbers? Let me rephrase that. Anybody not have these numbers? Okay. All right. If we look in Learn Test Pass, just a few things here. First off, the Unit 11 and 12 materials kind of lumped together. It's all related to rentals and leases. Remember, 11 is the relationship between the landlord and the tenant. 12 brings in the agent. So as mentioned, just a few things that we've talked about. Last week, we mentioned the sample residential rental agreement. So I do have that in here for you guys to glance at. Here's these Q&A brochures that the Real Estate Commission provides. Are you guys here? Are you here? No? Hello? You are? Okay. Okay, good, 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 good. So Q&A brochures from the Real Estate Commission. There's one on the tenant security deposit, and then another one on renting residential real estate. So this goes over the Residential Rental Act. And then addition, we mentioned earlier today in Unit 12, we talked about our property management agreement. Please remember the property management agreement is the agency agreement. This is the agreement that creates the general agency relationship between the owner and the broker, the owner and the property manager. I have the PowerPoint that we just went through, the profit and loss math. So you guys have that in here. We're also recording. So if you want to go back through, you can pause it or rewind or whatever. And then there's some additional profit and loss math in here. What is there, about 5 extra problems? So you got the numbers in the book, plus you have this in Learn Test Pass. And then of course I've included the solutions so you can grade yourself. And why is it not loading? It's here, there it is. Okay. Questions, Unit 11 or Unit 12? What's going on with the internet? Just a quick reminder, you guys have a cram course this Saturday, 9 to 1. So I think I told you guys last week that I would email you the link on Friday. There's been a little change. Lane is going to email you and Zoom link on Friday. So be on the lookout for an email from Lane. And the reason being is because Anne usually sends Lane with some worksheets, some supplemental stuff. So when she emails you guys that Zoom link, she'll have a PDF attachment for you guys to look at. So Lane's going to send you guys the email. Did I say 9 to 5? Yes, is the cram course time. And that's with Anne Rashid. It's optional. There's no additional cost to you guys. It's included. If you can't come for the whole day, I encourage you to come for the time period that you can. If you can only come for the morning or the afternoon, I think any little bit helps. I believe Anne's main focus is going to be state-specific stuff in math. I don't know exactly what all she goes over, but it'd be a really good review for you guys right before your exam. If you don't get the email from Lane by, say, Friday when you're sitting down for dinner, then let her I know so we can make sure that you get it. A question comes in, are they allowed to adjust the rental lease, or is it just the contract, it's all standard form? Are you allowed to adjust the rental lease? Let's see. You're talking about the rental agreement. Remember, only the parties to the contract can add, edit, draft. So technically, the lease is a contract between the tenant and the landlord. So only the tenant and the landlord can draft, add verbiage. Also, don't forget, you guys, for your exam next week, I need you in a distraction-free zone. If you don't have a quiet place where you're all alone, you really need to tell your family, your pets, everybody to leave you alone. If I see you talking to anybody, the Real Estate Commission says I can only assume that you're talking about the test. So please, please make sure you are distraction-free. Give yourself that. A lot of you tell me that you stress out when you take tests. So give yourself that quiet, distraction-free place. Fair enough? I do get asked a lot, what if I read the problem? I can tell the difference between you guys looking at a problem, reading the word, then you sitting here chit chat and having a conversation with somebody in the room. Do you guys see that? So if you are in the habit of moving your mouth when you read, I can tell, I can try to tell, but please understand, you guys, PSI Testing Center is not going to allow it. If they see you're moving your mouth online, they're just going to assume you're talking. If you're in person, you obviously can't talk out loud. So I hate for you guys to form those study habits. I'm starting to get a lot of questions about the test. That's the very last thing we're going to do this week. Last thing we do on Thursday is talk about your test and the course exam. So I'll address those at the end of this week. A lot of you sent your kids back to school this week. That's one way to to get distraction free, right? There you go. That works. All right. So I need to stop sharing for 1 second, grab us another PowerPoint. Where we're heading next is Unit 19. Unit 19 starts on page 476. So I'm getting this. You guys can be finding that. Come back and get you guys. Unit 19 is our fair housing unit. Unit 19 is not only important for your test, you're going to see some test questions in Unit 19, both mine and your state exam. But Unit 19 is also very important for your career, for your real estate career. I don't know much that can get you in trouble faster than violating fair housing. Remember, the commission's main purpose is to protect the public. And the public is protected under fair housing. So violation of fair housing, and we're going to talk about what happens if you do violate fair housing. But I'm telling you, the Real Estate Commission will get involved. Any violation, the Real Estate Commission will get involved. I think it's important as we go into fair housing that we understand fair housing is not here for you to agree with or disagree with. Fair housing is what it is. So any of your personal opinions, beliefs, whatever, they need to be put off to the side when you're practicing real estate. Fair housing is very, very protective of their public and the protected classes that we'll go through in just a second. So whether or not you agree with what I'm saying, doesn't really matter. Fair housing says this what it is. This is how you're going to practice when you're dealing with housing practices, helping people sell or lease properties. So in Unit 19, we're going to describe the purpose of the Civil Rights Act of 1866. We're going to talk about the Federal Fair Housing Act as we know it today. We're going to list and define and have a conversation about who the protected classes are. Who does fair housing identify as the protected classes? There's federal fair housing, and then there's a state level as well. So not only do we have federal fair housing, but we also have North Carolina fair housing. We will talk about that. And then we're going to talk about how both federal and state fair housing is enforced. Who is the enforcement agency and how does that work? So first off, let's talk about the big picture. Fair housing's big picture is about equal opportunity. And the big picture of fair housing says anybody should have the right to live whatever they want as long as it's within their financial means. As far as where you want to live or who you want to live here, that's why fair housing has protected classes. And as long as they can afford it, they should have the right to live where they want. Failure to comply is a violation, as I said, of the North Carolina Real Estate Commission, License Law and Commission Rule, discriminatory actions. There's also civil and criminal violations. This could be on the federal level. This could be on the state level. So let's go back in time just for 1 second and talk about how we got to be where we are today. And the first piece of fair housing started with the Civil Rights Act of 1866. If you know your history, you know 1866 is about when we were ending the Civil War. And a result, one of the things that we got from this new movement was the Civil Rights Act of 1866. And what this says is it prohibits discrimination on the basis of race. Now we are going to talk about the protected classes, including race, and define the protected classes in just 1 minute. So bear with me. We will define the protected classes. The Civil Rights Act of 1866 is one of the things that still applies today. So even though this is one of the oldest laws that we have, it still applies today. And one thing that makes this unique is there are no exemptions. We're not just talking about housing. When we say no exemptions allowed, we're referring to housing, of course. We're referring to commercial, employment, a pickup game of basketball. You can never discriminate on the basis of race. So it all started in 1866. No discrimination on the basis of race. Now let's fast forward 80 years. 80 years later, the Civil Rights Act of 1866 evolved, and it became known as Title VIII of the Civil Rights Act of 1968, also known as federal fair housing. So we went for 80 years where race was the protected class. And then in 1968, we evolved, we adopted federal fair housing. And in addition to race, in 1968, we also said for housing, you cannot discriminate with color, religion, and national origin. And again, we will define the protected classes in just a second. So 1866 prevented discrimination on race. Fast forward to 1968, we evolved to fair housing and also picked up protected classes of color, religion, and national origin. Did I get my years wrong? Thank you. Sorry. 66. Yeah, you're right. 120. 100, whatever. Fast forward in time. I do math, but I don't go off calculator. There's a reason why. Okay. Fast forward again one more time to 1974. In 1974, fair housing said you can no longer discriminate against sex. In 1974, sex was added as a protected class. In February of 2021, under sex, now protected by fair housing, is gender identity and sexual orientation. So under the category of sex, as of 2021, gender identity and sexual orientation is now a protected class. And then fast forward one more time to 1988, where fair housing picked up handicap, disability conditions, and familia status. And we will talk about what familia status means in just a second. I do recommend that you guys know the years that the classes became protected. I do recommend that you know these years. I would not put it past them onto your exam to ask you a question that says something like the year is 1972. A woman applies for an apartment and feels that she was discriminated against because she was female. Is there anything she can do about it? And in 1972, was she protected because she was a female? No. So not only do I recommend you need to know the classes, I'm telling you that you need to know the classes, but I also recommend that you guys know the years. So you know if this scenario, that individual fell under the protected class. Please look with me in your book on page 477. 477. And there's a pretty good chart in your book on page 477 once we make an edit. So 477, I got to make an edit to the chart. I have everybody on page 477. Do you guys see that first Civil Rights Act of 1866? And in your book, it says race and color. The only thing protected in 1866 was race. So get your white out or your Sharpie or whatever and cross out the color under 1866. The only thing protected in 1866 was race. Once you make that edit, I think this is a pretty good chart. And what I like about this chart is it tells you the various acts and when each protected class was adopted. So you got 1866 was race. In 1966, we evolved to fair housing. And in addition to race, now we picked up color, religion, and national origin, picked up sex in 74, and handicap, disability in 88, familia status in 88. Y'all, 1988 was not that long ago, was it? Federal fair housing is still evolving. Like I just said, in 2021, we picked up gender identity and sexual orientation. So fair housing continues to evolve. And as a licensee, you need to stay current. The other piece on that chart on page 477 is Equal Credit Opportunity Act of 1974. Those are the lenders' protected classes. We met the lenders' protected classes back in Unit 15. The lenders' protected classes, race, color, religion, national origin, sex, age, marital status, and public assistance income. So our protected classes are similar, but you need to know equal credit opportunity protected classes are different than fair housing. The real estate brokers protected classes are different than the lenders protected classes. Everybody see that? So like that chart, once we make that correction, so let's talk about the protected classes. Let's define fair housing protected classes. Who are fair housing's protected classes? Some instructors do fresh corn. I like Fred's corn. Doesn't matter to me how you do it. The difference is whether or not you use disability or handicap. If you're using fresh corn, you're using handicap. If you're using Fred's corn, You're using disability, as long as you remember it. Fred's Corn helps us remember the protected classes. The vowels are not protected classes. They're just there so I can spell the word. Familial status deals with children. Children under the age of 18 and pregnant women are protected under familial status. I don't think this comes up, let me rephrase this. I think that comes up more in lease, residential lease situations than it does for sale. And as a lease, a residential lease, you can't not rent property to a family with children. Children are the protected class. So familial status is about the children. Age is not a protected class in fair housing. What's protected is the children. Any children under the age of 18 and pregnant, children soon to come. We're going to talk more about familial status in just a second, so bear with me. We're just defining the protected classes right now. The R in Fred's Corn is race. When we talk to race, we're referring to the group of people that an individual was born into or has affiliated with their whole lives. When we talk about race, we're referring to the group of people that the individual was born into or affiliates with. Fred Flintstone, man. The E, again, equal rights for all is not a protected class. I just use that as a filler so we can spell Fred's. The D in Fred's is referring to disability or handicap condition. Disability or handicap condition is referring to any physical or mental impairment. Any physical or mental impairment that limits one or more of life's major activities. Let's pause here for 1 second. Let's go back to Unit 7, way back, Unit 7. And we first officially met material facts in Unit 7. And we also talked about things that are not material facts. And one thing we said that was not a material fact was stigmatized properties. If you're asked, is this house haunted? Did anybody die here? You don't have to answer that. You can hide behind state law. It's not a material fact. But remember, we also said there's an exception to that. If you're ever asked, did somebody live in this home that had AIDS or HIV? Your answer is always, federal fair housing prohibits me from answering that. Because those with AIDS or HIV are protected under disability handicap status. So whether you know or not, your answer is always, federal fair housing prohibits me from answering that. I have never been asked that, but I need to know how to respond if I ever am. So disability or handicap status. The S in Fred's Corn is referring to someone's gender. And as of 2021, February 2021, Sex Now also recognizes gender identity and sexual orientation. The C in corn is referring to color. When we're talking about color, we're referring to the actual color of a person's skin. So race is the group of people you were born with or identify as. Color is the actual color of your skin. Again, the O is not a protected class, opportunity for all. It's just a filler, so I can spell the word corn. Religion is the spiritual beliefs of an individual. The individual spiritual beliefs. And then the N in corn is national origin. National origin is the country in which the individual was born or their direct ancestors hail from. National origin is the country in which the individual was born or where their direct ancestors hail from. Here's the deal about federal fair housing's protected classes. Let's first talk about what they don't say. Federal fair housing does not say, here's the protected classes, don't you say anything bad about them. That's not what federal fair housing does. Federal fair housing says, here are the protected classes, don't say anything at all. They are protected. We can talk about the property, the amenities, the neighborhood all day long. We cannot talk about the people. So just because you might be saying something good about a protected class doesn't make it okay. Fair housing says they're protected. Don't say anything at all. Again, talk about the property, the neighborhood, the amenities all day long. Do not talk about the people. Now, a few minutes ago, we mentioned familiar status, and I feel like this comes up more in lease than it does for sale, but it does come up in sale as well. First off, a lease. If you're a property manager and a landlord looks at you and says, or an owner, excuse me, looks at you and says, I don't want to rent to a family with kids. We as property managers, we as licensees need to know, we need to have this conversation with our owner. I cannot discriminate against the family that has kids, even though kids may destroy, they may, put purple crayon on the walls and they may, destroy the home. This is why you have a security deposit, right? You can't not rent a unit to a family because they have kids. What about for sale though? You know what comes up in for sale? You're going to have a buyer look at you and say, I want a neighborhood with kids so little Johnny has somebody to play with. Fair housing says I cannot, now I'm not going to ignore it. I'm not going to dodge it. We need to address it, but we need to be careful on how we address it. I can't say, well, this family has kids and this family doesn't. We can't talk about the people. If your buyers want a neighborhood with kids, let's look at the local amenities. What are the schools? Are there any parks nearby? Is there a rec center? And just because there may be kids in the neighborhood, there's no guarantee that little Johnny's going to get along with them, right? So we're not going to go there. We're not going to have that conversation. Guys, remember, we're telling our buyers to drive through the neighborhood periodically anyway. So if they want to know there's kids, they just need to pay attention. Sometimes you see a lot, kids playing, kids crossing. You guys see like those little green people now with the flags that say, drive like your kids live here. Should that tell you there are kids in the neighborhood? Possibly. So there are amenities, there are features that we can look at, but I cannot say, well, yeah, there's 5 kids down the street for little Johnny to play with. Everybody with me? Talk about the amenities and what's nearby, the features. We cannot talk about the children. They're protected classes under familiar status. Question comes in, can they change the deposit because of children? Remember, the Tenant Security Deposit Act limits how much security deposit we can collect. And also remember, what you do for one, you do for all. So if you have an apartment for rent, you say this is a security deposit. What you do for one, you do for all. Again, back in Unit 7, we introduced you guys to OCAR. We said as a licensee, OCAR is that fiduciary relationship that you owe your client. And one of our words in OCAR was obedience. And obedience says I follow my client's lawful instructions. Anytime I'm asked to violate fair housing, they're asking me to violate a lawful instruction. I follow their lawful instructions, and violation of fair housing is not allowed. You very well, at some point in your career, for example, be at a listing appointment where the owner looks at you and says, I don't want to sell my house to fill in the blank of a protected class. Your response is, Mr. and Mrs. Seller, fair housing says we cannot discriminate on who buys your house. We cannot discriminate against that protected class. Well, I don't care. I don't want to sell my house to anybody of that protected class. Back and forth and back and forth. And at the end of the day, if you can't get them to understand your duties, your rights on fair housing, you may be best not to take that listing, because nobody, no client, buyer, seller, owner, landlord can make you violate fair housing. And if they insist, I can't answer that question for you. You may have to have a conversation with your BIC. But if they insist, I'm telling you, you may be best not to take that listing. You may be best to walk away. Once you get an offer from a buyer, now you have a different conversation, right? You may need to get your BIC involved. Your BIC may choose to terminate the listing. No, I'm not. It's a perfect offer, but I'm not accepting it because the buyer's a member of the protected class. We need to, guys, please remember, a big part of my responsibility, my job, is to help educate the public. And when you have a seller, for example, that's insistent on not accepting an offer from a buyer for the only reason because of a member of the protected class, that's our opportunity to help educate. And if they still insist, get your BIC involved fast. Questions about the protected classes? So if the seller asks questions about the buyer's race, color, etc., we're not supposed to give that information. That's correct, because the buyer's race, color, etc. are the protected classes. What should the seller care about? The only thing the seller should care about: can they afford to buy the house, right? That's it. That's it. What I hear once, the only color that the seller should see is green. That's it. Okay. Again, we're going to touch a little bit more on familiar status, handicap in just a second. Make sure we understand those. I also got some exemptions to fair housing. I know I get asked that about a lot, but just give me a minute because there are a couple exceptions. So we'll talk about that in just a second as well. Equal opportunity in housing. This all comes from the Department of Housing and Urban Development, also known as HUD. And one thing that HUD does to promote equal opportunity in housing is require places of business to put equal opportunity in housing's poster up for the public to see. Now you can see this poster on page 478. Gotcha, thank you. So on 478, it gives us a poster. HUD makes this available to businesses. And we tell the public pretty much it's got to be in a public place. You can't have it in the break room where the public never sees it. But what we're pretty much doing, places of business that deal with housing, real estate offices, model home, model homes in a new construction development, lenders, property management offices. Anytime you're dealing with housing, this equal housing opportunity poster tells the public that we're not going to discriminate. And as a matter of fact, HUD, they don't really require this poster, but HUD pretty much says, look, failure to put the poster up on its face is seen as discriminatory practice. So just by saying, I'm not making this poster available to the public, HUD says you're discriminating. Another thing I want to point out, in Unit 19, there's some good examples, and I got some good examples for you guys in Learn, Test, Pass as well. So I'll show you where those are. But page 479, just make yourself a note. Figure 19.3 gives you some good examples, what's prohibited, examples of that. Again, everything to help you better grasp, better understand the protected classes. And then a little further down, 479 to 480, we got some expanded definitions. So first off, when I refer to housing, we're referring to the dwelling that is meant for occupancy. What constitutes housing? It's where one or more family lives. It's the dwelling, it's the unit that is designed for occupancy. Familial status, again, is about the children. Pregnant women are protected as well. If I get asked a question, is there a park nearby? Can I answer that? Can I answer that? Is there a park nearby? Sure, because I'm talking about the amenities. Can't you go to Google Map and see if there's a park nearby? It's right there. You can't hide that, right? What if I'm asked, do any kids live here? Are there kids in the neighborhood? That's what we mean by talk about the property and the amenities all day long. I can't talk about the people. You will be asked sale or lease. This comes up quite a bit. And again, it's having an understanding of what and how we can address that, how we can answer. If your buyers are asking you if kids live nearby, respond with some questions. Do you want some information about the schools? Do you want to know about parks? Do you want to know about fields and rec centers, soccer fields, whatever, rec centers? What if you're a property manager and you're managing an apartment building that's, I don't know, 15 stories. It's a big old apartment building. And you have a family apply for a unit on the 15th floor, and they have 3 kids under the age of 5. Can I deny them that apartment on the 15th floor because I care about the safety of their kids? I think you should live on the first floor because that would be a lot more safe. Can I do that? Absolutely not. If they apply and they qualify for, we cannot deny them. I can't, and I'm going to talk about steering in just one second. Yep. So as a property manager, I can't have specific, family friendly or safe apartments for families with children. Make sure your balcony is reinforced. Make sure all that's up to code. But you can't deny them rental on that 15th floor because they have children. The other expanded definition we have on page 480 is about handicap condition, disability. Landlords in a lease situation, landlords are supposed to make reasonable accommodations. Let me rephrase that. In a lease situation, landlords have to allow the tenant to make reasonable accommodations for their handicap. So if you are a landlord and your tenant needs maybe a ramp so they can get to the property, maybe they're in a wheelchair. If you're a landlord and your tenant, again, is in a wheelchair and they need the kitchen cabinets lowered, or they need a grab bar installed in the shower, the landlord cannot tell them no. The landlord has to allow the tenant with the handicap or disability to make those reasonable accommodations. Now, the landlord can charge the tenant, they can make them do that. A lot of times the tenant has funding available. And the landlord can also require the tenant to put it back in its original condition after the tenancy. So if you have a tenant, again, is in a wheelchair, and they say, I need to put a ramp up so I can get to the front door, the landlord cannot say no. They cannot deny them to make those accommodations. They can require the tenant to put it back up after the tenancy. Remember, we said earlier, ADA is about the public spaces, fair housing is about the dwelling, the unit. Because ADA is about the public places, the landlord is responsible for making those accommodations. This is only referring to the housing, the dwelling. The other thing I want to point out real quick on page 480, do you guys see that in practice? Under handicap, in practice? Those that are abusing legal or illegal substances are not protected. However, those in some kind of recovery or rehab are also protected under handicap disability. A question comes in about that 15th story apartment. Can I make recommendations? I, as the property manager, show that family the units that I have available for rent. So here's a first floor unit and here's a 15th floor unit. Guys, remember the big picture. Let's step back for 1 second. The big picture of fair housing says anybody should have the right to live wherever they want, as long as it's within their financial means. So if you have 10 kids and they really, really want the 15th floor, do your credit check. You cannot deny them. You can show them what you have available. Can the landlord legally offer at a cheaper rate a handicapped accessible unit to those who are not handicapped? Again, I go back to what you do for one, you do for all. If this is the rent for this unit, then this is the rent for this unit, regardless if it's handicapped, the individual or the property has been made accommodations for certain handicaps. Okay. All right. Great time again. So let's take 10. We come back, we keep going in unit 19. All right. Welcome back. We are taking attendance. And, oop, just got you. Getting back into Unit 19. Over on page 481, as we mentioned earlier, there are some exemptions to fair housing. One of those exemptions to fair housing is the sale or rental of a single family home. So in other words, the for sale by owner or the for rent by owner, according to fair housing, is exempt. They don't have to abide by fair housing, federal fair housing, let me phrase that. They go on to define who is that sale or rental of a single family home. So basically we're looking for sale by owner, for rent by owner, someone that does not own more than 3 homes at a time. A real estate agent is not involved. A licensed broker is not involved in the transaction. And federal fair housing, while they may allow exemptions for the for sale by owner or rent by owner, they never allow discriminatory advertising. So if you own a property, you may be able to choose who lives in that property, but you can't advertise your discrimination. So in other words, in the ad for sale or the ad for lease, you can't say, you know, females need not apply, for example. We will see this in just again when we talk about state housing. But right now we're just understanding that this is an exemption to federal fair housing. Discriminatory advertising is never allowed, ever. Even though you may be able to choose who you sell or lease to, you cannot advertise your discrimination. I know we see it all the time, don't we? Craigslist, we see it all the time. But fair housing says not allowed. You cannot advertise that discrimination. Another exemption to fair housing, federal fair housing, is a rental and an owner occupied. So let's say you have a duplex. You live in one of the units and you're trying to rent out the other unit. That may be exempt from federal fair housing because you own, the owner occupies because you live. Some religious organizations own property, so they're exempt. They can have property just for their members to use, not open it up to the public. For example, churches may have a parsonage for the preacher to live in. Any private club, property owned by private club, can say only members only. They do not have to open it up to the public. They can only allow their members. That's correct, Brittany. Yep. And then another exemption is housing for older persons. Remember, the only age that's protected under fair housing is 18 and under, the children. Once you turn 18, there is no protection for age under federal fair housing. So when we talk about an exemption housing for older persons, when you have communities that were created and designed specifically for older persons, they have an exemption, and the only exemption is familial status. They still can't discriminate on race, color, national origin, religion. You guys with me? So housing for older person, the only exemption they have is the familial status. Again, there's rules, there's rules. You can't just, do it. You have to, the housing has to be developed, intended for older persons. They can say, 62 only apply or 55 only apply. Again, it's only exempt from familial status. It's not exempt from the other classes. Everybody good with what I'm saying? So even though you're exempting the children because you say 65 or older, for example, You still can't discriminate on the other protected classes. So let's talk about these housing for older persons. Can the grandkids come visit grandma and grandpa the weekend? Can they bring their little backpack and visit for the weekend, a couple days, maybe a week in the summertime? Of course they can. What I'm telling you is they can't move in because they were designated solely for housing for older persons. Enforcement of federal fair housing. We're still on federal fair housing. So how federal fair housing is enforced by the Fair Housing and Equal Opportunity Department under HUD. HUD regulates fair housing. HUD and the Office of Fair Housing and Equal Opportunity have the right to file a lawsuit if they feel there was discrimination. There could also be civil and criminal penalties. If an individual feels when it comes to housing that their protection, they were violated, the complainant has up to 1 year to bring enforcement. So if you apply for apartment and you were denied, and you have reason to believe, strong suspicion that you were denied because of your membership of one of the members of the protected classes, the complainant has up to 1 year to file that complaint. And guys, please remember too, any violation, any lawsuit, any kind of penalty, the Real Estate Commission will probably take discriminatory action. Please remember, the Real Estate Commission isn't going to fine you. You get fined by the judge. The Real Estate Commission regulates your license. So when we say disciplinary action from the Real Estate Commission, they can suspend your license, revoke your license, and we will talk more about that when we get into our license law and commission rule tomorrow. So federal fair housing enforced by HUD through a division of HUD. The complainant has up to 1 year to file a complaint. We also have a state level of fair housing. So the state level, and here's the good news. The protected classes for the state level are the same for the federal. Some states have additional protected classes. But in North Carolina, our North Carolina protected classes are also Fred's Corn. Same protected classes as federal. And really the only difference between federal and state fair housing is some of the exemptions. So remember, for federal, we said if you're a for sale by owner or you're for rent by owner, you can choose who you sell or lease your home to. That's a federal law. State comes in and says, nah, the for sale by owner and the for rent by owner is not exempt. Anytime you have a conflict of law, the stricter of the two will prevail. So in North Carolina, can the FSBO discriminate? Can the FRBO discriminate? And the answer is no, because the state is stricter than federal. So if this wound up in court, the judge would look at federal fair housing, they would look at state fair housing, and the stricter of the two would prevail. Another difference in the exemptions between federal and state: federal allows rental exemption only if the owner lives in a unit. State allows a rental exemption if an owner or their immediate family member live in the unit. So federal has its law on this, state has it. Again, in this case, federal is more strict than state. So if this wound up in front of a judge, federal will prevail. So just a side-by-side comparison. Federal versus state. It wouldn't be uncommon for a complaint to the federal level to be pushed down to the state. It wouldn't be uncommon for a complaint to the state level to be pushed up the federal. And it certainly wouldn't be uncommon for the Real Estate Commission to get involved as well. So, I mean, again, you know, not only could you be fined by the courts, but you could also face disciplinary action from the Real Estate Commission. We'll talk specifically about the brokers and our roles more specifically in just one second. Another exemption that state has that federal does not, we have an exemption on our single sex dormitories. So all of our college dorms, our military barracks. There's some exemptions there. Federal is regulated by a division of HUD. State is regulated by the North Carolina Human Relations Commissions. So who enforces, who regulates? It depends on if you're talking about federal or state. Federal is regulated and enforced by a division of HUD. State Human Relations Commissions. As with a federal, a complaint to the state level, complainants have up to 1 year after the incident that they felt that they were discriminated. They have up to 1 year to file the complaint. And the judge and or the Real Estate Commission, they're going to investigate, do their due diligence to get both sides of the story, and then proceed from there. Either put in penalties on page 384, page 384, there's some prohibited practices. Block busting, it's also known as panic peddling. This is when you're dealing with sellers or owners of property. Block busting is about the sellers. Block busting is about the sellers or the owners of a property. And what block busting is, it's the act of encouraging people to sell or rent their home by claiming the entry of a protected class into the neighborhood. You cannot encourage someone to sell or rent their home by claiming the entrance of a protected class into the neighborhood. Block busting is about the sellers, the owners. Steering, also known as channeling, is about the buyers and tenants. Steering is about the buyers and the tenants. You can't steer or direct buyers or tenants into or away from a certain neighborhood because of members of the protected class. You cannot steer. You're not going to say something like, you know, the neighbors are like you. Live here because people are like you. Or don't live here because people aren't like you. That's steering. You can't steer or direct buyers or tenants into certain areas because of the presence or absence of a protected class. Advertising is never allowed. Discriminatory advertising is never allowed. You cannot advertise a property for sale or rent that has any kind of language in it that may indicate a preference or a limitation of one of the members of the protected class. You can never, no matter who you are, licensed or not, you can never advertise your discrimination. Redlining is a prohibited practice of the lender. Redlining is a lender prohibited practice. And what redlining is, this blows my mind, this is used to exist. It's not allowed anymore. But lenders used to have big maps of the city on the wall in their office. So they have a map of the city, and they would actually take their red marker and walk up to the map and say, we're not going to issue loans in any home that's located here, here, or here. They would actually circle certain neighborhoods, certain subdivisions, certain areas, and say, we're not going to originate a loan to anybody that wants to buy a home here. That's called redlining. And today is not allowed. If you're getting denied a loan, it better be because your debt to income ratio doesn't shake out. The individual property may not qualify for an FHA or VA loan. Remember, we said that appraisal process is a little tighter. So the individual property may not qualify. But if the property doesn't qualify, it's because it's the conditions of the property, not where it's located. Do I have everybody? So they can no longer just do a blanket, no loans here, and that's what redlining was. Another good one on page 486, another good figure has HUD's advertising guidelines. And we say that HUD is, or fair housing is constantly evolving as society changes, so is fair housing. For example, in your book on page 486, you guys see the first category there, race, color, national origin, and what is permitted. You see where it says master bedroom? We're starting to do away with that terminology. Master bedroom is already being replaced with primary bedroom or owner suite. So even as we speak, just since this book's been published last, our advertising guidelines are evolving. Our advertising guidelines are changing. I'll share with you guys the Triad MLS, the first of this year, like January 2nd, I think it was. Triad MLS rolled out a new software, and the software has a bank of words that if I put a word in my MLS app when I'm inputting the listing in the MLS, if I put in one of those words, it's going to flag it. It's going to say, you need to make sure you're using this word appropriately. So once they rolled out this software, for example, I was putting a listing in for one of our builders. And in the remarks, I was talking about the white cabinets in the kitchen. And it flagged it. It didn't tell me I couldn't say it. I couldn't use the word white, but it flagged it to help me make sure I was using that word appropriately. Am I using the word white to talk about things such as cabinets, or am I using that word white to talk about people? So they did not let me, everybody good? They did not let me put it in, but they just said, whoa, whoa, make sure you're using this word white appropriately. That's Triad MLS. If you don't have it in your MLS yet, I'm sure it's coming. Triad MLS has already replaced master bedroom with primary. Primary bedroom is the new verbiage that they use there. We're going to talk about some resources for you guys in fair housing in just a minute. Fair housing training is ongoing training. So once you get your license, it's going to keep coming up in your sales meetings with your firm, maybe your local Board of Realtors. The National Association of Realtors is very committed to fair housing training. We'll talk a little bit more about some of those resources in just a second. But I just think it's important that we know that fair housing isn't stagnant. It's constantly changing, constantly evolving. And you and I as licensees need to be up to up. We need to make sure. Be careful in your advertising, you guys. Y'all know how online works, right? Once you hit submit, it goes out there and it's awfully hard to get it back, isn't it? So if you're not sure about your advertising, best to have your BIC or somebody put another set of eyes on it. Have somebody else look at it. And that's part of what Triad MLS is doing by, again, I don't know how many words they have in their test bank, But if you try to put a listing in, they want to make sure that when you say white, you're referring to the cabinets and not the person, the people. Yeah, for some, I was like, what did I do? And I was like, no, it's good. It's good. They're just making sure. I mean, yeah, they give you like this big yellow explanation point and everything. Yeah. And I'm like, oh, I didn't do. They're just making sure before you submit this, just making sure you're using this appropriately. North Carolina has some laws to protect the tenant, specifically about sexual harassment, to protect the tenant. So the tenant can't be forced or feel forced, in exchange for rent or a lower rent, any kind of hostile or intimidating or offensive environment. The tenant should not feel subjective to that. They go on to differentiate the different types of sexual harassment. Verbal is suggestive comments or jokes. Nonverbal might be obscene gestures. And physical is inappropriate touching. Again, the tenant is protected, North Carolina law. So on page 488, y'all make a big note, big star. Look at page 488 if you haven't already. Let's talk about what all this means for the broker. Brokers can be found guilty of discrimination even if there was no intent to discriminate. This is worth me saying again. What you do for one, you do for all. Let's say, for example, I'm doing an open house on Sunday, and I have my open house registry in the kitchen, and I have cookies and bottled water. And somebody comes into my open house and I say, thanks for coming. Please stop by the kitchen and sign my registry and have a cookie. And then somebody else, and then somebody else. And then maybe I get to talking or I'm distracted. And somebody else walks in the door and I don't tell them to have a cookie. I don't tell them to sign my registry. Did I just treat them differently than I did everybody else that came into my open house? They very well may interpret that once they hear me tell the person after them, sign my registry and have a cookie, they may interpret that as she's discriminating. She doesn't want me to have a cookie because I'm a member of the protected class. So what you do for one, you do for all. If you make cookies available at your open house for one, you make cookies available at your open house for all. I may not have intended to discriminate, but it's not my intention that HUD and state level enforcement is going to look at. They're going to look at, did the individual feel that they were discriminated? So intent doesn't matter. What you do for one, you do for all. HUD is who provides guidelines for advertising. Again, this test bank of, I don't know how many questions or how many words. HUD's the one that provided, for example, the Triad MLS with those words to flag, just to make sure they were being used appropriately. Also for the broker, what we need to know, we have our equal opportunity housing poster that we saw at the beginning of this unit. National Association of Realtors is very committed to fair housing. They suggest that poster or some kind of sign stating that discrimination is against company policy because we follow federal and state laws. And you'll remember our agency agreement. Remember we looked at our listing agreement and our buyer's agency agreement. And when you look at your property management agreement, our agency agreements must contain that non-discrimination clause. So remember, the agency agreement is what creates a relationship between you and the member of the public. So by requiring that statement in our agency agreements, we're letting the public know we will not discriminate based on the members of the protected classes. So we saw that when we talked about our agency agreements must. And one of those musts was that it has to contain the non-discrimination clause. So an owner can discriminate when renting out rooms or a unit in a 1 to 4 complex when the owner or owner's family occupants. So remember, in that case, federal is going to be stricter than state. So you can only discriminate when you live there. Federal wins on that one. It's stricter than state. There's some good, page 489, some kind of good situation responses. Again, I think Unit 19 does a good example, giving us examples. So if you haven't already, when you go through Unit 19, make sure you're looking at the examples, the in practices for examples, that situation and response. That kind of helps bring it home. Side-by-side comparison. ADA is for public accommodations. 15 or more employers, the employee has to provide public accommodations. Fair housing is for the housing. So if you are a property manager of a large apartment complex, for example, you have the unit, you have the apartment or the dwelling, but you also have common areas. Those are your public accommodations. So that property manager is going to have to be familiar with and abide by both fair housing and ADA. I've had numerous people that work for property managers take this class. And one thing I've always heard is that ADA and fair housing is good to send out secret shoppers. They will actually have people call the apartment complex and say things to see how the person answered the phone responded. I had one lady that worked for an apartment complex. She says like 150 units, bless her heart. She always looked frazzled the first of the month because she's trying to collect rent from all those people. And yeah, she said that she got those secret shopper calls all the time. Just seeing how you respond and making sure you respond appropriately. First time, they usually just slap you on the wrist. Suggest you get further training, further education, get a better understanding. After that, they may start putting fines, implementing fines. As we mentioned earlier, Equal Credit Opportunity Act are the lenders protected classes. When you guys see credit, think lender. So the lenders protected classes, race, color, religion, national origin, sex are same as what we have. They also have age, marital status, and recipients of public assistance. And that's where I think more helpful than this slide is that chart back on page 477. So you can do, again, it's just a very nice side-by-side comparison. Lenders protected classes do not include familial status, which makes sense because if you're 17 years old, you can't get a loan anyway, right? So when we talk about age, we're referring to adults. So for the lenders, if a 90-year-old comes in and applies for a 30-year loan, they can't be denied because of their age. Again, if you're getting denied a loan, it better come down to your debt to income ratio. The other thing that fair housing has that lenders do not is disability handicap status. They're not protected under Equal Credit Opportunity Act. So again, I really like that chart on page 477 once we make that change. Back to page 491. Last little piece of this unit. Code of ethics. Once you affiliate with a firm, your firm will have you join the local board of realtors. Membership at the local board of realtors will get you in the state level, so you have access to the forms, and it'll also get you into the national level. Only when you become a member of the National Association of Realtors can you call yourself a realtor. All realtors are brokers. Not all brokers are realtors. It's a different level of membership. Once you become a realtor, we have a code of ethics. You'll get your code of ethics training, part of your new agent training, your new agent orientation. They'll teach you about the code of ethics then. And what these code of ethics does is provide realtors with certain standards on how we ethically conduct ourselves when we're dealing with the public. They used to, once you get licensed and you go through the new member orientation, they used to require you to do code of ethics training every 4 years. After that, a couple years ago, they said, no, that's not enough. We need to change it to 2. Last year, they went for the Goldilocks. So as of today, once you're licensed, go back to code of ethics training every 3 years. You can possibly also make it count for your continuing education credit for that year. We'll talk about CE when we get to license law and commission rule. But it's a good reminder, again, things evolve, things change. So it's a good reminder, and this is why they require that training today, every 3 years. You won't be tested on that, but just FYI. If you're not a member of NAR, don't worry, because the North Carolina Real Estate Commission license law and commission rule does mostly parallel NAR's code of ethics. So once you are licensed, you're held to a higher standard. Once you join NAR and you have that realtor designation, that's what the public recognizes. So what's the benefit of that membership? The public tends to recognize that. Whether or not you have to join NAR or not is up to your firm's policy. So if that's something that's important to you or not, make sure you're talking with your firms as you're interviewing to decide which firm you want to join and whether or not they require you to join NAR or not, up to firm's policy. And that gets us through 19. Key terms, again, the big thing about 19 is understanding the protected classes. So the protected classes, the key terms. Key point reviews on 492. And then your student quiz on page 494. Got a few more resources for you guys. We'll go there in just a second. Questions on 19? Fair housing? If we look really quick, there's just some, what did I just do? Oh my goodness. Hang on, I hit a button. No. Okay. If we go into Learn, Test, Pass and look under the 19 material, I got some good stuff in here for you guys just to help you better understand. So first off, this piece, again, that I really like, these Q&A pieces from the North Carolina Real Estate Commission. So they provide a Q&A brochure on fair housing. I do suggest you look over this in addition to Unit 19, of course, to help you get a better understanding. Another thing I got in the Unit 19 material, if you're familiar with the market, one thing that buyers have been trying to do to make their offer more better, if that's a word, to the seller is by, with their offer, presenting this love letter. Like, we're in a multiple offer situation, and this is why I think you should pick me to buy your home. And the concern and what this article is addressing is with these love letters, it's very easy to hit fair housing. So if your love letter says something like, I can see my family and I spending Christmas in the living room, you just hit on two in one sentence, didn't you? Family and religion. And the concern is that the seller could look at those letters and say, well, goodness, they're like me because they're, celebrate Christmas and have families. And that could direct the seller. So they're discouraging, they haven't outlawed it and they've said it's not illegal, but they're discouraging the use of the love letters. Sellers should be choosing buyers based on, the terms of the offer. So how much are they offering, due diligence, earnest money, right? How does the offer look and not the people? One thing that's come from this multiple offer world that we're living in that I really like is agents with multiple offers. Everybody understand we still have to present the offer. I still got to send the offer, but to help the seller sort through it, agents are doing like an Excel spreadsheet and saying like, here are the terms of offer number one, here are the terms of offer number two, here are the terms of offer number three. So then that way the seller's just looking at sales price, due diligence, earnest money, dates, that kind of thing. And they're not so much focusing on the people. So again, whatever we can do to help our sellers make a decision based off of the offer. Everybody with me? Not the people. They haven't outruled these love letters yet. They haven't said they're illegal yet. But they are saying, make sure you proceed with caution. So I did put this was May of 2021, but I put this in here. I also have fair housing case studies. So here's like a case study and it puts you in a situation and it says, how would you respond, A, B, C, or D? And then of course I have the explanations as well. So it tells you, what they think that you should, how you should respond. If you're looking at yourself thinking, well, this looks like Julie copied it straight out of a book, you would be right. The book that it was copied right out of is the North Carolina Real Estate Manual. Can you guys see that? It's backwards, I know, but the North Carolina Real Estate Manual. So once you guys take post licensing, you're no longer using a textbook. Post licensing comes from the manual, and they have a whole unit dedicated to fair housing, including these case studies, again, which I think help wrap our brains around it. And the other thing I have in here is a piece from continuing education from CE 2020, 2021 year. And while I don't think you guys should sit down and read this whole thing, I mean, it's available to you if you want to, but the reason that I included it for you guys is because they have these 4 discussion problems scattered throughout. So here's a discussion about Betty hires Ray, da, 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 da. So it kind of, again, puts you in a scenario and helps you see the outcome. And the outcomes, the discussion is at the very end. So if you see a 4 discussion scenario, then you can get the explanation at the end, all in this same PDF. So again, I mean, this is 24 pages. I'm not telling you not to read it. If you really want to, it's available to you and you can. But the reason I put it in here was for the scenarios, the in practice, to help you get that better understanding. Jones versus Mayer is in your book. We did not mention that, but yes, it is in your book if you'd like to look at that. Plessy versus Ferguson, also mentioned in your book. Studying some of these past court cases will help us better understand why we're here today. Questions? Fair housing? National Association of Realtors, 2020, I think it was, that sounds right. 2020, they ruled out a simulation. You guys remember those books when you like the Choose Your Own Adventures? So it's kind of like that, and it's a simulation, and they have a fictitious town called Fairhaven, and you are the real estate agent of Fairhaven. And so you are introduced to clients, buyers and sellers of all members of protected classes. And again, they put you in situations, and depending on your response, whether or not you can proceed to work with your next client, or if you need to go back and, do something different, do something better with this client. I can't get you guys into that yet. You got to have an account with the National Association of Realtors, and I'm not giving you my login and my password. So, but just make a mental note that once you get licensed, NAR has that. It's a pretty cool simulation. And then they have, they training once a year, always ongoing training. It's just one of those things, you guys, that isn't stagnant. It's one of those things that you always need to be current on and making sure you're practicing and following the laws to protect yourself, but also to protect your clients and customers. Do we talk about the process of joining NAR? Nah, I'll let your future BIC talk to you guys about that. So if you're interviewing, if you're talking, I'm sure that'll come up in the process, but you're not going to be tested on that. So we don't talk about that. Yep. Okay. Everybody good? Good. Moving right along. I am watching my time. I know I owe you guys a few minutes from last class, so I will get us out of here a couple, 2-3 minutes early. And of course, I'll stay after if anybody has specific questions. But we're going to get started in Unit 18 today. I probably need about 10-15 minutes to finish it tomorrow. So we at least need to get started. And Unit 18 is our basic tax unit. Do I have any accountants? I think I've asked this before, but do I have any accountants on the call, CPAs? Some of you are so funny. You look scared when I ask you this question. No, I'm not an accountant. I hear you. This unit introduces us to some basic taxation of owning real property. Once again, this is very basic. A lot of this class, I fear, is teaching you guys just enough to be dangerous. But if your buyers or sellers or owners in a property management situation have a lot of questions about their real property taxes, this is when we need to know to have them talk to their accountant. So having this basic understanding allows us to know what my lane is, what lane to stay in, and when I need to advise my buyers, sellers, and owners to get with an accountant. So basic understanding of taxation. In this unit, we're going to identify some tax benefits of home ownership. And we'll also go over some itemized deductions that you may be able to take. And then I know that says calculate. I think we've picked up our last calculator for this class, by the way. Did I say that after you? I think that's the last time we need to pick up a calculator. But we do have a couple formulas in Unit 18 that we need to understand. So I know that says calculate. I don't think you're going to see math, this math on your exam, but we do need to know the formulas. We need to know how to get to this. So that's what we're going to do in this unit. This unit breaks taxation down into two different categories. So there's taxation for an owner occupied, and there's taxation for an investor. So let's first start talking about taxation for owner occupied. And as property that you own, that you live in, you may be eligible for some tax deductible expenses. The interest on your mortgage that you pay this year may be tax deductible. Call your accountant. The year you purchase your home, if you purchase discount points, that may be tax deductible. Remember what we said discount points were? They are just prepaid interest. So the year you buy your home, you prepaid interest, that prepaid interest may be tax deductible. Yes, it may be on the test. Mortgage prepayment penalties. If you are charged with a prepayment penalty, that may be tax deductible. Insurance premiums, your PMI, mortgage insurance. And then some loan origination fees may also be tax deductible. Again, I'm not an accountant, I'm not a CPA, So if you're wondering about yourself personally right now, my advice to you is call your accountant. As the real estate agent, when you have a buyer buy, they start asking you a lot of questions, especially first-time home buyers, and especially their first year of home ownership. I would encourage them to get an accountant to make sure that they're getting all of the tax deductible expenses. And the other thing, as an owner, you may be able to take tax deductible expenses for our current property taxes. You're not going to be able to benefit from paying delinquent taxes. So in other words, if you never paid 2021 taxes, you're not going to get a tax break for that. It's only current year's taxes. That's one piece of it. Personal residence, owner occupied. The second piece of it is when you're working with investors. There's certain tax breaks, tax benefits for investors. So let's first start defining some words. On page 464, 465. And some of these words, first thing tomorrow morning, when we come together, we're going to put in formula. So some of these words I'm giving you the definition for now, and then when we come back together tomorrow, we'll put them in formula, understanding how they work. Capital gains for investors is the amount realized from the sale of real property. Capital gains is the amount that you realize. How much did you gain from selling the investment property? Cost basis is the owner's initial cost. Cost basis is the initial cost. Capital improvements are any improvement to the property that add value. Capital improvements add value. Ordinary wear and tear does not fall under the category of capital improvements. Painting a room is not a capital improvement. The cost basis plus the capital improvements is the investor's adjusted basis. Adjusted basis is the cost basis plus the capital improvements. And then the amount realized is what you sell the property for. The investor cares about, what did I pay for it? What did I do to it while I owned it? And what do I sell it for? And again, we'll put these words into formulas. So don't go anywhere just yet, because I do want to, because I'm getting a couple questions here. So we define the words. Again, we'll pick back up here tomorrow. I do want to let you guys go a few minutes early, but don't forget, in Learn, Test, Pass, under the 100% material, you want to know what's on my test? End of course review. You want to know what's on your state exam? Syllabus. So the 100% material and Learn, Test, Pass, you guys got a week, so you may want to start putting it all together. Tomorrow, we're going to finish 18 pretty quickly. We're going to blow through 16 pretty quickly. It's about 7-8 pages, I think. So we'll get through 16 really quick. And then we go on to license, law, and commission rule. So remember, we're looking at the comments and license, law, and commission rule. And we'll go from there. So get you guys out of here a few minutes early since I kept you late last time. Thank you for your patience. I hope you guys have a good day, and we'll see you at 9 o'clock tomorrow morning. We'll do it again. Thank you. Yeah, no, sleep too. You guys got that Europe song, Final Countdown? I always hear that about this time of class. I should play that tomorrow morning. Will YouTube let me do that? I won't be recording. It's their versus mine. We're getting there though. What questions do we have? What can I?
Oh, I just wanted to say that I think I like the quizzes or the review test questions that doesn't give me the actual answer.
Okay,
Because when
good.
I take it again, I have to like, think about it, like about the answers. And I already know one of the answers is out if I had it wrong, you know what I mean?
Right, right.
So
So
I think it's
so
helping me more that
good.
way.
So what she's referring to, for example, let's see, where's one? Under the 75% material, this is what you're referring to? This is the same
Yeah,
quiz, it's just two different modes. So
yeah.
you one through the exam mode where you just answer A, B, C, D, 1, 2, 3, 4, 5. And then you can go back through it again with the review mode. And that's what gives you the explanation. So thank you for
Mhm.
saying that. I do think because we got to get you in exam mode, right? So if you can go
Yeah.
through it kind of pretending like this is a real test, kind of like you did your midterm. Pretend like
Mhm.
this is a real test. And then, even if you say, well, gosh, I really didn't understand number 3, then you can go back through the review mode and find out that explanation. So there's a
Yes.
75%, and then also the same thing in where is it? Yeah. Exam
So I
mode.
think it makes me think even more like, like what answer I'm gonna pick or whatever. And I can go back and then do the other review and actually would tell me the answer, the explanation for the answer.
Good. Good. Thank you for
So
sharing that.
thank you.
Absolutely. We'll see you tomorrow.
All right, bye-bye.
Let's see. I got a chat here. Math question. Okay, from the booklet. So let's see. Booklet, page 21. Twenty-one. Oh, number 3. Okay. So what are we talking about? We're doing profit and loss. So Sarah purchased a home. She borrowed 400 and paid the balance in cash at closing. 1 year later, she sold the home for 690. What is her rate of return on equity? She purchased for 490. She borrowed 400. She paid the balance in cash. So today she had debt, right? But today she doesn't. So 1 year later, she sold the home for 690. What is her return of equity? Okay, so what's the question here? And this just might be more, this isn't something specifically that we talked about, but this might just be more getting us, thinking about how this works. So what we're saying is when she purchased the home back in the day, she purchased it for 490. She borrowed 400. So 400,000. So her equity when she purchased it was 90,000. And then 1 year later, she paid it off. So 1 year later, her equity is the value because she no longer has debt. So when we're looking at her return on equity, we'll probably be looking at there's your differences. She only had 90,000. Again, equity is the money that you have in it. I'm curious. I'm just going to cheat real quick. See what what they're looking for specifically. That's pretty vague to me. So it might just be trying more get you to think, you know what I'm saying, about the equity. So this is the profit and loss. Let's just cheat and see what they say. Profit and loss. Number 3. Yeah. Yeah, because the problem is she paid it off, right? So she doesn't have any debt. She paid her balance at closing. So it's probably not the best question that we have, you know, because it's so vague. It just doesn't give me enough information. So we could kind of rule that one out. But it gets us thinking about equity. And that sometimes that's what we need to do, is think about how we can calculate equity, how that works. And then counting days for proration. You had a question on that?
Yes. So on when I'm doing the mini CDs,
Mhm.
I'm having issues because on some things you count from when the owner has it to give it to the seller, and then some things are the seller to the. I'm so confused on which one. I'm trying
Okay. So the difference, who do you count for? That
Yeah.
takes us back to asking ourselves, who owes whom? So, how do I say that? Who owes whom? So you're buying my house today. Taxes are probably not paid because the
Mhm.
bill hasn't come out yet, right? Because we're still in August, we're not September yet. So if you're buying my house today, taxes are not paid, that means somewhere later in the year, you're going to be responsible. Now it's coming out of your escrow, so you're not going to sit down and write a check. I didn't say you paid. I said you're going to be responsible.
Mhm.
If you're responsible for the whole year, then we got to ask ourselves who owes whom. And in that case, I would owe you some money, right?
Yeah.
Because
Mhm.
you're going to be responsible for the year. What do I owe you for? The period of time
That I own the house.
that I own the property. That's
Okay.
what I owe you for. So I think if that's what answering that question of who owes whom, debit to one party, credit to the other. And then whomever owes, it's going to be their period of time.
Okay.
So in this case, this would be a debit the seller, credit the buyer for January 1st through and including today. That's what I owe you,
Okay.
because that's a period of time that I own the property. And that's, do you draw the timeline? Do you find that?
No, I
helpful?
just
I
use
like,
fingers.
you just use the fingers. I like the timeline because it gives me a visual, you know what I'm saying? So once I draw it out, do my annual timeline or monthly, if I'm doing HOA taxes, for
Mhm.
example, whatever my timeline is, what am I figuring out? The dividing factor, what separates everything, is the day of settlement. So now we see the seller owned the property here, the buyer owns the property here. So now the next question is who owes whom? And that depends on if they've been paid or not. So I
The buyer would
think the
start
visual,
counting from the 24th.
and the buyer, and the buyer doesn't owe that money, right? They're not bringing that to closing. The only thing that we're getting at closing is what the seller owes the buyer.
Okay.
This is, in this case, this is that much less money that the buyer has to bring to closing because
Okay,
they're
so it would
getting
be a credit.
their credit.
Okay.
So now fast forward to November, when the buyer goes to, or the buyer's lender goes to pay that bill, they've already received the seller's
That
portion.
portion okay, awesome. So then I would just prorate it and put the debit for the seller, the debit for the buyer, whatever
No, you were
portion.
right the first time. Debit
No?
the seller because the seller owes the buyer.
So you wouldn't put
Debit
it
the
in the CD.
Yes, it would be a double entry. It
Okay.
would show up as a debit to the seller and a credit to the buyer
Okay, got you.
in this case.
You're killing me.
Try drawing the timeline. And if you have a
Okay.
specific example, of course, we can look at that. But
Which
try
one?
drawing that timeline because, like I said, that gives me the visual. Now I can actually see. I mean, I'll be honest, when I prorate, I actually have to sit down and ask Julie, who owes whom? And
I
it's the
understand.
timeline that helps me
It
see
is
that.
it kills me.
So, once I figure that out, if the seller owes the buyer, we're
Mhm.
looking at the front part of the year because that's when the seller owned the property, right?
Mhm.
If it's a debit the buyer, credit the seller, now we're looking at the latter part of the year because that's when the buyer owned the property. So what period of time we're counting depends on who owes whom.
Who owes who? Okay, so on page 15, they have two CDs.
Page 15, where? Here
In the booklet. Hmm.
in the workbook? Okay, so page
Mhm.
15. Okay, 2 CDs.
And I was just doing, I don't know why I keep getting dates wrong.
So I got, and I'm just fast forwarding here. So we got taxes are estimated to be 1350 and are unpaid. So
Mhm.
as soon as it comes time to prorate, my suggestion is to draw it.
Draw the timeline.
And this is annual taxes. So no, my timeline is for a year. You know, if it was HOA dues, it might be a year, it might be a month, right? It just depends on what we're talking about. But I know I'm talking about annual taxes. So no, my timeline is for a year. The problem has to tell me when settlement is. Settlement is my
25th.
dividing factor, right? So in
Mhm.
this case, we're going to go to closing on May 25th.
Mhm.
Where'd my mouse go? There we go. The seller owns the property the front part of the year. The buyer owns the property the latter part of the year. So now that I've taken the words from the problem,
Mhm.
I put it in a visual. And that's all I'm doing here. I'm taking those words and putting it in a visual. I just took the information from the problem and gave myself a picture. The problem tells me that the taxes are unpaid. So what does that mean to you if taxes are unpaid?
That is gonna be a credit, a debit to the seller. Yes, I put in debit to the seller.
Debit to the seller and a credit to the buyer. So in other words, what you're saying is the seller owes the buyer for the period of time that they own the property. So they owned it from the first of the year to
525.
5/25. And so however many, and you know, we can do that math if you need help, of course, but we just take our annual taxes and divide by 360. So you'd have January, February, March. So there's 120 days. I need a calculator. 120 days plus 25. So there's 145 days that the seller owned the property this year. And that 145 days is what the seller owes the buyer for.
I'm gonna get on the same page as you. Let me see, 145.
Sure. Take your time.
Mm. 20. And then plus 25. Nope, I messed it up. Okay, okay. Now I see how you got 145 days. It takes I don't understand. My fingers are not working.
Kick your shoes off and count on your
I
toes
know.
too.
I'm about to start counting on toes, okay? Because I'm sitting there and I'm like messing up.
And see, when you're calculating for the seller, when you're calculating the front part of the year, you don't need your fingers. We can do 30 days in January, 30 days in February, March, and April. That's 120 days plus 25 gives you the 145.
Exactly. So
Where I need you to whip out your fingers is when you're calculating for the buyers.
Okay.
Because the buyers responsibility would start on the 26th, right? And
Yes.
where the confusion is 5/26 to 5/30, it looks like 4 days.
Yeah, but it's 5.
But you're actually looking at the 26th, the 27th, the 28th, the 29th, and the 30th.
I think in that one, I also have to do you had to do real property taxes in that one too for the buyer too.
No.
I think that was just the escrow account.
Yes. Just the escrow and possibly interim interest too, right? If we're calculating.
Yeah, we had to do interim interest.
Yep. But when we prorate, think of it this way: a true proration is a debit to one party and a credit to the other for the same amount.
That's true. Accounting.
Okay. Right. So let's pretend that settlement statements don't exist for a second. Okay. Just pretend that you're going to buy my house today and we're stubborn and we're going to go on our own and we're not going to do it with an agent and we're not going to do it with an attorney. You and I are just going to go do it, right? Nobody else involved but me and you.
Okay.
And at some point you're buying my house. And at some point you're going to go, oh, Julie, you owe me for taxes. If we didn't have anybody else involved or settlement statement, I would actually hand you a check, right? That check would be a debit from me and a credit to you. And the amount of the check didn't change, would it?
No.
it would be the same amount.
Yes.
So now in reality, we have attorneys and brokers and settlement statements, and I'm not actually giving you a check, but we are going to hash it out on the settlement statement. We got to finalize everything today, which is what settlement is about.
Okay, awesome.
So that's all a proration is.
Okay,
Credit to one party, debit. Somebody owes somebody some money.
okay, awesome.
Okay.
Well, I am
Let's see
done.
the other one. Let's see if this one's
Oh, that one is fun too. They're all fun.
paid by the, so this is a good one too, because this is a little bit different than what we've been talking about.
Hmm.
So this one tells us the taxes and have already been paid by the seller. Closing on this one is October 20th. So again, as soon as you see prorate, my suggestion is to draw it out.
Okay,
So January 1st to the end of the year, what's dividing this year? It is the day of settlement. I don't need anything else but to know taxes are being prorated and the closing date. This is all I'm focusing on right now. I'm taking the words and I'm putting it in a visual. And now we go back to the problem and we see that it's already been paid by the seller, which means the seller has paid the entire year.
hmm,
So now we ask ourselves, who owes whom?
the buyer owes the seller.
Yep. So we would do a debit the buyer, credit the seller. The buyer's responsibility starts tomorrow
Hmm.
through the end of the year. So now we have 21, 22, 23, 24, 25, 26, 27, 28, 29. We've got 10 days left in October, 30 days in November, and 30 days in
Okay.
December. Maybe that helps if you know that whomever the debit is for, that's the period of the timeline that we're looking at.
And the good one about this one, it was for a seller, and they also had loan assumption in it too.
Oh,
So that
fine,
made it
yeah.
easy. That was-
You know,
that
that's
was-
just more, you're not gonna get tested on that. But just to have an understanding, you know what I'm saying? Just to have that
Mhm.
broader understanding. You will see taxes. You very
Okay.
well may see HOA, just part of the mini CD. But yeah, assumption just kind of gets you working that a little bit.
It did. It was interesting. Oh boy.
That's a good word you used.
Thank you
Does
so
that
much.
help? Does that answer?
Mhm.
Okay, good, good.
Thank
Well,
you
let
for
me know if you
listening.
have other questions.
Oh,
Absolutely.
I definitely will. I definitely will.
Keep letting me know. Yes.
Thank you.
Thank you. Have a good
Have a
day.
good day.